His Excellency Dr. Perry Warjio, the Governor of Bank Indonesia, Honorable Head of Delegations, panelists, moderators, distinguished guests, ladies and gentlemen. Assalamualaikum warahmatullahi wabarakatuh. Peace be upon us. Shalom. Om Swastiastu. Namo Buddhaya. Salam kebajikan to all of us. A very good morning to you all gathered here in BNDCC or BNDCC Nusa Dua, Bali. My name is Timothy Marbun, and it is an honor for me to once again host you in today's Gala seminar. Praise to the presence of God Almighty because of His blessings in these very precious moments, ladies and gentlemen. We can gather here at the G20 Gala Seminar Series in the G20 side event, broadcasted live from the Island of Gods, Bali. Ladies and gentlemen, today's seminar is part of the Gala Seminar Series that we have started on Friday and will be held in 3 series with selection of topics from Indonesia's G20 priority agendas as we aim to recover stronger together. We will begin with monetary and financial sector policy to support stability and recovery, which will be followed by central bank digital currency and crypto assets. And the last session is on green economy and finance. On that ground, we are proud to present you with our distinguished and renowned speakers in their respective areas who we will hear firsthand from our speakers, their insights and also their experiences. Now, before we continue, allow us to show you a video that will take you to our topics today.
Under Indonesia's G20 presidency, we are working hand in hand to achieve global recovery. After several working group meetings, 3 deputies meetings, as well as 3 ministers and central bank governors meetings, we are making progress in reaching understanding on policy responses to control the impacts of the pandemic. And the conversation continues. In response to the pandemic, governments have implemented fiscal measures to assist businesses and vulnerable groups through incentives, social safety net, and tax measures. On the monetary side, authorities have set accommodative policies to support the economy, as well as ensuring sufficient liquidity in the banking system. When it comes to fiscal and monetary policy, the key is to work together, complementing each other. As digital innovations accelerated due to the pandemic, central bank digital currency, or Cbdc, becomes a topic of interest. Numerous central banks have actively engaged in international discussions on Cbdc. The focus? To achieve optimum benefit for public welfare while preserving the international monetary system and financial stability. One thing that the pandemic has taught us is that the global economy is vulnerable from non-traditional potential shocks, including climate change. The impacts of climate change is estimated to be much larger than the pandemic. Therefore, global cooperation is essential in dealing with climate transition issues, including to foster ambitious climate action through information sharing and collective actions. Another difficult situation we are facing is geopolitical crisis. Many countries are under the threat of stagflation, where stagnant growth meets high inflation. Indonesia invites policymakers, along with experts and market players, to share insights on navigating current trends and threats in the global economy and finance. Together, we need to find ideas and solutions toward an even and sustainable recovery.
Legal being created to strengthen the power of people. In any challenge, in any circumstances, we have to get together and to reach out. To recover together, recover stronger.
Thank you very much, ladies and gentlemen. We're beginning today with a round of applause, and let's continue our Gala Seminar Series today. Our first theme for today is monetary and financial sector policy to support stability and recovery. Excellencies, ladies and gentlemen, this panel discussion will be moderated by the Governor of Bank Indonesia, Bapak Peri Warjio, who is also host and chair of the G20 Indonesia Presidency Finance Track. And speaking in this panel are Mrs. Sheila Bazarbazioglu, Director of the Strategy, Policy, and Review Department, SPR of the IMF. And also joining them is Mr. Hyun Song Shin, Economic Advisor and Head of Research of Bank for International Settlements. Ladies and gentlemen, please welcome on the stage Mr. Peri Warjio, Mrs. Pasar Bazioglu, and Mr. Hyun. And on this panel discussion, ladies and gentlemen, will be opened with remarks from the Governor of Bank Indonesia, who is also our moderator. Therefore, the stage is yours, Pak Peri.
Thank you, my brother, little brother, Timothy Marbun. Governor below from Reserve Bank of Australia, all fellow governors, minister, my dear friend, Board of Governors of Bank Indonesia, Senior Deputy Governor Desi Damayanti, Deputy Governor Dodi Budiwaluyo, my dear friend Sheila and Jung Song, ladies and gentlemen, very good morning, very good morning. Please big applause for this session. Come on, once again, big applause. This is the third series of the 5 series the under G20 presidency put together, the Gala seminar. Now, it's not only a seminar. This is Gala, ladies and gentlemen. You know Gala, right? We are putting a series of 5 Gala seminar to discuss as well as to communicate what the G20 holding up together to solve the global problem of today. To recover together, recover stronger. Last Friday, we discussed 2 series of Gala seminar. One, we talking about how to address the food security. Thanks to Kingdom of Saudi Arabia, we joining with us G20 on arranging and putting together global solution for food security, because that's one of the problem. On Friday, we have Secretary Yellen, Minister Sri Mulyani, MD Kristalina, as well as Agus Ikasan, talking how macroeconomic policy being coordinated become macroeconomic policy mix, fiscal policy, monetary policy, structural reform to address the global problem, to lift up economic growth, which is slowing now, but with G20, we are hoping and acting together to recover. We thanks for those 2 series. And today, we are talking about how to bring about price stability, monetary stability, financial stability, which is a key to support not only economic recovery, but also to get back global economic growth to stronger footing. And later on, we're talking about central bank digital currency as well as green economy. So let's begin. Let me start with the following 3 points. 1, the problem of monetary and financial stability of today. Second, how central bank policy make, monetary policy make, need to be strengthened to address that. And third, of course, on the financial stability. How can we mix with monetary stability to solve the problem? Let me start with the first. We know that the global now facing increasing inflation. The issue is that this inflation is coming from supply side, coming from global supply chain disruption. Also, the impact of the war in Ukraine. Then the question, if the inflation coming from supply, some of countries, advanced and a number of emerging countries also coming from demand. But many of emerging countries, the demand is just increasing. How then we address that? Do we need to address all of them by interest rate increase? Or there should need also respond from the supply. Second, also the impact of Fed fund rate increase and other central bank interest rate increase. Of course, the respective domestic mandate need to be put first. But how to address those impact in very open global economy? How the impact of those to capital flows, exchange rate volatility, will interest rate enough to address not only the inflation but also to offer spillover of capital flows and other aspects. And this is the issue. How then in the financial stability? Still, we are still addressing scarring effect. Some of them already recover, but others companies are still in the recovery. So this is very challenging and complex words for central bank around the globe. How to balance to bring back price stability, at the same time to address also capital flows volatility, exchange rate volatility, but still then not worsening the global economic slowdown. This is a very complex challenge, very different the episode from the past, which is mostly the problem coming from demand and all from the financial sector. This time around, many of them coming from supply side. Second, but we are fortunate. We have IMF working very hard. BIS is working very hard. The IMF formulating advices for us, for the global, for the members. Not only how best to address this issue with the policy mix at the juncture, but also formulating a new approach of integrated policy framework. This is, Sheila will tell us about this. And also we are fortunate that BIS also addressing this from the macro financial policy stability framework. How monetary policy, macro prudential policy can be combined, still supporting the price stability, the monetary stability, but also supporting financial stability and also the role of those to the economic growth. This is the second that we will discuss. And the third, of course, this is also the challenge in Indonesia. In Indonesia, thanks goodness, our inflation still well controlled. Last month is 4.35%, but now it's increasing. But our demand is still weak. Most of the inflation coming from food prices of the global. And with that, we are also facing the global spillover, capital outflows, exchange rate volatility. And our financial sector now start recovering. You know, when economic cycle is just rising, financial cycle is following. We are still on that. So what we do in Indonesia, of course, we are starting to normalize our monetary policy. But macro-prudential still accommodative. In monetary policy, we started with normalize our quantitative easing in the past. We start withdrawing our liquidity by increasing reserve requirement. We also, to avoid capital flows and exchange rate volatility, of course, we stabilize exchange rate. Not to targeting certain level, but to mitigate the exchange rate pass through the inflation as a part of management. This is what we do. And with that, of course, when the inflation fundamental start kicking, inflation expectation start kicking, then of course, under our framework, we do not hesitate to respond from the interest rate. The timing, well calibrated, well planned, well communicated, becoming important. Our macro-prudential still accommodative. We are doing a lot of accommodation in macro-prudential because our financial stability, credit growth is just rising. So we do relaxation on a number of policy, whether about loan-to-value ratio, whether about on the liquidity, as well as also even we are giving incentive for bank to lend to the priority sector. So that's the third that I want to say. First, we are facing a very complex challenge from the central bank. The impact of war, the global disruption chain, as well as financial stability, volatility in the global. Second, we are fortunate the IMF and BIS giving advice for us, as well as also proposing some new framework that may also, and we do hope so, also addressing the problem. Bringing back stability, but not, so speak, worsening the global economic growth. This is what also Indonesia doing to bring back our stability and also to support our economic recovery. Let us start with the first speaker. I do not need to introduce. My dear friend Stella Pasarioglu, she is the lady of the IMF. In her hand, the strategic policy of the IMF being formulated, being assessed, and also advised to us. Two questions, Stella. First, how the advice of the IMF on this aspect. Second, you can start with second on the first, it's up to you. Can you share us the integrated policy framework? You can start with integrated policies framework and how those can be applied in this very complex challenge. Big applause to Sheila, please.
Thank you. Thank you, Governor Perry. It's a pleasure to be here with everyone and, of course, my friend, colleague, Hyun, and I look forward to the discussion. This is a very difficult time to be a central bank governor. It's, as you said, it's very complex challenges, unprecedented challenges. We were talking before the seminar. I joined the fund in 1992. That's 30 years ago. And we have seen many crises. I worked on many different difficult times. But this is really unprecedented, what we are going through right now. And I do hope that we can take the necessary policies to avert a crisis going forward. But I must say, we are very concerned about what's going on. What I'm going to do, I have a short presentation. I have about 10 minutes, I was told. What I'm going to do is I'm going to set the stage first, just to give you a sense of how we see the situation at the fund, and then focus more of my time on, as you said, integrated policy framework, the challenges, and also the lessons that we have learned from the past in dealing with some of the problems that we are addressing now. So if we go to the next slide, please, just, you know, the global outlook, it's not very favorable, as you said. We are going to come up with our update of the global outlook, which is going to be before the end of the month. We will downgrade our forecasts substantially. And if you look at some of the recent data, like manufacturing sentiment, which is on the left-hand side, inflation, which is well above target for many countries, the global outlook is clearly deteriorating. If you go to the next slide, please. Risks are downside, and what is worrying us is that there are many different shocks, and even if each of the shocks would be possible to address individually, when you have many of these shocks which are interconnected, it becomes much more challenging. So you talked about commodity prices. We have seen they have stabilized more recently, but we have seen food prices increasing, oil prices, which has implications for many countries. We have seen capital flows to emerging market economies for the fourth consecutive period really declining very substantially. And we also have a slowdown in China, which has consequences for the rest of the world in terms of spillovers. The pandemic is not yet over, so it's shock after shock, which are really hitting the global economy. And what that means, if you go to the next slide, we are talking about the implications for financial stability as well, which is really critical. We have seen improvements since the global financial crisis. G20 did come together after the global financial crisis in 2008, and we did see unprecedented coordinated regulatory reforms. And if you look at on the left-hand side, the capital for bank capital for advanced economies, which were actually quite low, and the quality and quantity was low, increasing substantially. Same, of course, for emerging market countries, many of whom have started in a better position. We have global stress tests that we report in our Global Financial Stability Report. The one here shows the impact of the pandemic. Now, of course, we have these other shocks, and it has implications, especially for emerging market countries. So we start from a better position in terms of capital in the financial sector, but we do have a weak tail of banks, both in emerging market countries, but also in advanced economies. We go to the next slides. What is worrisome is the corporate sector vulnerabilities. So we are at a record high level of public sector debt and private sector debt, 256% of global GDP debt. And corporate sector, if you look at the share of vulnerable firms, those that have low liquidity, high leverage, and low profitability, this has been increasing more recently. And if you look at the debt in terms of the industries that are contact extensive, the blue bars in the right-hand side, you do see that these industries and these countries have really increased their debt levels. So the corporate sector is highly leveraged, and in many countries it's actually in foreign exchange, which exacerbates the problems. Next slide shows some of the vulnerabilities in emerging market countries. We have 1/3 of emerging market countries with yields about 10%, spreads about 1,000 basis points. Spreads have been widening. And what is worrisome in the last month is that we did see before a differentiation between commodity exporters and commodity importers. That's gone now. You also see quite a lot of pressure on even commodity exporters because of the broad inflationary pressures. So I think all of that means that we are in a very difficult position, both in terms of the government debt, the corporate sector, the financial sector, the tail end of the financial sector. If we go to the next slide, we published a report earlier this year looking at crisis preparedness. We have a new indicator. It's actually looking at the institutional framework and the tools, so out-of-court settlement systems, liquidity procedures, and so on and so forth. And if you look at non-performing loans, countries which have high non-performing loans and limited crisis preparedness, these are the green and orange dots, some of the emerging market and low-income countries. This is becoming worrisome as well in terms of the gaps in dealing with some of the potential insolvencies that may arise. And I'd like to underline here something we have learned very forcefully. We were late during the global financial crisis, but we have learned it very forcefully, the importance of asset quality reviews and understanding the quality of assets in bank balance sheets, with corporate sector at risk, with the regulatory forbearance which was needed during the pandemic. There's much more, there's lack of transparency and opaqueness. So I think it's very important for supervisory authorities to do the asset quality reviews, to understand what could be the problems, and take remedial action going forward. If we go to the next slide, and I will end in terms of all the concerns, because the concerns have been adding up, government debt holdings. So many of the emerging market countries, on average, 1/5 of banking sector assets are in government securities, 200% of bank capital. What that means is bank sovereign nexus is high, and of course any issues, any distress or increase in spreads in the government bond market has implications for corporate sector and the financial sector. And the right-hand side is some analytical work we have done to look at what would be the implication of such sovereign distress on bank equity capital, as well as their ability to lend. And in this environment where growth is under pressure, this has, of course, implications. Again, putting at forefront the need to be preemptive and take action. So what can we do? What are policy priorities? In the next slides, monetary policy. You mentioned it. It's very important. Hyun will talk about this as well, to be front-loaded, to take action, because being late is going to be much more costlier than being preemptive in terms of really addressing the monetary policy constraints and the inflation, to make sure that the expectations do not get de-anchored. Central banks' operational independence. This is a very hard one. I've seen it. For 30 years, central bank independence has been critical. And we see it in countries where central bank independence is under question, how that has really devastating implications. So importance of, this is to ministers of finance and others, to respect and preserve the operational independence of central banks so that they can do what is in their mandate. And also macro-prudential tools as needed to deploy them, which means, I mentioned the stress tests and AQRs, but also making sure that some of the macro-prudential tools which are really part of the integrated policy framework to be used. If we go to the next slide, I'm not going to talk much about this, but this is the collateralized loan obligations. We were worried about this before the pandemic. We forgot about it, but I think it's important to make sure that we do take actions in terms of leveraged behavior in the non-bank financial sector. I think this is an area where the IMF has been on record, and FSB has been doing work, but I think this is very important to mention as well. What are the lessons from IPF? On the next slide, I put a few bullet points on this. What we learned with the IPF is that there are certain factors that make countries much more vulnerable to capital account reversals. And that's when countries have very high unhedged foreign exchange debt and liabilities, poorly anchored inflationary expectations, less credibility of the central bank, shallow domestic debt markets and FX markets, as well as, of course, dominant currency pricing, which is the case for many of the emerging market countries. What that means in terms of the policy mix is that we can't, in some countries, we can't just rely on full exchange rate adjustment, especially in countries where the FX markets are not deep or market access is under question, inflationary expectations are not anchored. We need to make sure that, and my time is up, so I'm going to be quick and can come back to some of these issues in the question and answers. We should be able to use foreign exchange intervention as appropriate, as well as capital flow measures on outflows. And the next slide I'm going to end with, which is very critical as you are the G20 presidency at these very challenging times. There are issues that we can only address at the multilateral level. Each country on its own is not going to be address them. But this is really critical because we also see, on top of all the concerns, we also see social tensions rising in many countries, and that requires multilateral action to deal with food insecurity, to deal with debt problems in some of our member countries, And also, the next session, you will discuss cross-border payment systems and digitalization and climate crisis after that. So really importance of multilateralism to deal with these challenges. And we as the fund stand ready to provide bilateral, multilateral advice and working with countries, as well as, of course, our lending instruments, both in terms of precautionary as well as program context to many countries. Thanks again.
Thank you, Sheila. That's excellent presentation. Big applause for Sheila, please. We just hearing the global facing a very complex and unprecedented challenges. Rising inflation, slowing down growth, volatility of capital flows, exchange rate, the risk to corporate debt, as well as also other complex issues. Second, on the central bank, of course, bring back the price stability from monetary policy response. With that, of course, there is also complementary tundrus monetary policy response to bring back inflation, price stability. For emerging countries that have shallow FX market, exchange rate intervention warranted. Not replacing, but complementing. Also, capital flows management for the outflows. On the macro-prudential, selective macro-prudential targeted, which is address and mitigate the risk to certain sector. Let's go to that monetary stability. Let's go demand that has been living and rising after the global financial crisis. He's thinking always on the importance of financial system stability. He is senior advisor and head of research of the Bank of International Settlement. He is also the man that formulating macro financial stability policy framework. Mr. Yu Song Sing, please. Young Song, same question. What the BIS, what the macro financial stability policy framework is all about, and what you advise on this very complex challenge that was alluded to earlier by Sheila. Young Song, please.
Thank you, Governor Perry. It's a great pleasure to be here, and thank you to all of you for this very kind invitation. What I would like to do to begin with is to draw some lessons from the recent BIS annual economic report on inflation and the path to a soft landing. It's narrowing, but we think it's still a feasible path, but certainly not a very easy one. When I actually spoke at the first G20 seminar last December, I actually wrote these words. Supply bottlenecks have grabbed all the headlines recently, but the theme that you have chosen, recover together, recover stronger, also prompts us to consider the longer-term structural changes brought about by the pandemic and the policy measures. It's particularly apt now as we look ahead to future inflation developments. If we look at the first slide, I think it will give you a very, so the next slide, if you look at this slide, it gives you a trend GDP from before the pandemic to more recently. This is for a group of advanced economies. We saw this very sharp bounce back, but output is still below the pre-pandemic trend. If we look at the next slide, which is for emerging market economies, it's the same story. And Governor Perry, this is exactly what you referred to earlier, supply chain bottlenecks, the war and the commodity shock. And that's very much being played out across the world right now. So one message is that this inflation surge that we have seen very much is a supply side phenomenon, in that we had the supply bottlenecks, we had the war and the commodity shock. There was strong demand as part of the policy response, but the supply side just was not able to keep up with the very strong demand as we came out of the pandemic. And that was compounded by the impact of the war. And of course, some of those bottlenecks, the so-called bullwhip effects and other supply chain disruptions, they are now showing signs of easing. However, we've had these commodity shocks more recently. But what I want to do also in this opening presentation is also to draw attention to some of the more lingering structural changes that have been brought about by the pandemic. And if you look at the next slide, it tells you something about the importance of the labor market. So these are the changes in the labor market participation, both in advanced and emerging economies. And it's a very uneven picture, but labor market participation has been very uneven and it has not recovered everywhere. And if we look at the next slide, which is just a snapshot of the United States and the United Kingdom, just as two examples. These give you a sense of the longer term or the more lingering impact of the pandemic on the labor market. And these are so-called beverage curves, which give you the relationship between unemployment, measured on the horizontal axis, and the vacancy rate in the labor market, which is on the horizontal axis, on the vertical axis. And typically, it's a downward sloping relationship because when unemployment is low, labor market is tight, and vacancies are high. And conversely, when unemployment is high, that's when vacancies are low. So we typically think of the economic cycle being played out by shifts along the beverage curve. But what we have seen more recently is that there has been a shift outwards in the beverage curve, in that for the same level of unemployment, vacancies are much higher. So that's certainly true on the left-hand panel for the United States. For the UK, it's even more stark. Although here I'm measuring the unemployment in terms of the claimant count to working age population. And what this shows you is that there's been a shift in the supply side of the labor market, in that for the same level of unemployment, what we see is a more an adverse supply shock in the supply of labor, so that there are many more vacancies for the same level of previous measures of slack out there. And I think this does give us some pause for thought on how the current inflationary episode may have come up. And if you look at the next slide, which is a very simple textbook diagram, imagine that we have a simple textbook Phillips curve where we're measuring unemployment on the horizontal axis and inflation on the vertical axis. If the Phillips curve is very flat, as is shown here, a decline in unemployment would typically give rise to only a small increase in inflation, if at all, if any. But if we think of there being a supply shock to the economy, and the next slide shows a rightward shift in the Phillips curve, a negative supply shock pushes the Phillips curve to the right, which means that for the same level of unemployment that previously was non-inflationary or even only modestly inflationary, that is giving rise to a higher level of inflation. The problem is that once inflation is ingrained, what we can have is the next slide, which is when inflation becomes much more entrenched, inflation expectations become more backward-looking, And we could even think of inflation going up, and actually, as we described in the BIS annual economic report, having a transition from a low inflation regime to a high inflation regime, where a number of factors work in a concerted way to bring about a self-fulfilling increase in the inflation dynamic and give inflation some added further upward impetus. The key policy challenge right now, as you said, Governor Perry, is to bring inflation down. That is job number one. And clearly, monetary policy has a very important role to play. What we said in the annual economic report is that rates should be adjusted to more appropriate levels and do it in a front-loaded way so that we can actually have a timely and decisive monetary policy response. The real question is, how costly will that monetary policy response be for the real economy? If we look at this chart, clearly the output costs will depend very much on the slope of the Phillips curve. And what we did in a bulletin that we released just a few days ago was to look at the experience of 70 hiking cycles. And by hiking cycles, we chose episodes from 1980 across a large number of countries where the policy rate was raised over 3 quarters. And then we asked what were the preconditions that gave rise to hard landings on the one hand versus soft landings on the other, and how do those preconditions compare with where we are today. And then we also looked at, and if we go to the next slide, we also then looked at how this shift from high inflation to low inflation, how the fork in the road between hard landings and soft landings depended on the trajectory of the policy rate rise itself. And one very consistent message is that, as you see in this chart, is that a shorter hiking cycle where the interest rate increases are front-loaded, and those are the blue bars here in this box chart. So those front-loaded interest rate increases tend to be associated with softer landings. So there is less of an output cost, and you are more likely to be successful in bringing down inflation. What about the preconditions? Well, there the scorecard is quite mixed. So on the one hand, what we find is that when vacancy rates are very high, when growth is very strong, those are the preconditions which are more conducive to a soft landing. And that makes a lot of sense, in that if growth is already strong, then interest rate increases will tend to really only have a limited impact. If vacancies are high, you can trim labor demand without having a big impact on employment itself. So that's on the more optimistic side of the scorecard. On the less optimistic side, we find that when the yield curve is very flat, that's more conducive to a hard landing. When inflation has risen very rapidly recently, that's also not a very good sign. That is also more conducive to a hard landing itself. So the bottom line is that the scorecard is very mixed. However, if we think about central bank actions, where central banks take monetary policy actions in a rapid and decisive manner, and have a front-loaded response to inflation, that is more conducive to a soft landing. Now, let me conclude with the answer to your question, Governor Perry, which is, how does the BIS macrofinancial policy framework fit into this? And if you look at the next slide, we can do a couple of charts very quickly. As Gala also mentioned, level of debt. The level of debt is one of the worrying preconditions at the moment. On the one hand, This is a very interest-sensitive part of the economy, especially the housing market, that tends to go along with a steeper Phillips curve, and therefore it is going to be more conducive to a much more sensitive output reaction. However, it's a very double-edged sword in the sense that these impacts will go through the financial system. And for those economies that went through the GFC in the eye of the storm, they managed to reduce their household debt. For most of the other economies, that household debt continued to increase. And it's really the, as you see in these red dots, it's the higher debt service segment of the population which is going to be impacted the most. And for those economies that have floating rate mortgages, this is going to be a very big challenge going forward. And finally, if I go to the final slide, and this is where the global financial conditions come in. If we go to the next slide. This is the centerpiece of the BIS report on macro-financial policy frameworks that we submitted to your presidency. What it shows is the annual change, it's the yearly change in 10-year sovereign yields in local currency, of course, with a one-year change in the broad dollar exchange rate. And what you see is that exchange rates and external financial conditions have this financial risk capacity element as well, so that we have this reflected symmetry where when the dollar is strong, as is currently the case, this tends to be the period when you have tighter financial conditions as well. And what we say in the report that we submitted to your presidency is that it is unwise to burden only one aspect of your policy framework. So in particular, monetary policy or fiscal policy. You have to have a more holistic view. And in particular, right now, monetary policy is fully occupied with controlling inflation, and therefore it has to be the other complementary elements of your framework which have to come in. And clearly, having having larger buffers clearly will be helpful. But of course, in the current episode, we have to think about easing those same restrictions, and partly it's exactly what Jelly said. We have to think about market interventions that may mitigate some of the stringency of financial conditions, but also it has to be using regulations in a very judicious way and being able to adjust as needed. So let me conclude that.
Thank you, Young Song. Big applause to Young Song, please. And thank you, Song, for explaining the supply side of the inflation, the wage, the labor market, as well as macro-financial linkage, and some of the policy to address those. We will come back about macro-Prudential. So, ladies and gentlemen, global have challenges, and it's very complex challenge for central bank. So, welcome my dear friend, Governor Thomas Jordan from Swiss National Bank, and additional Governor Philip Loh. So give spirit and support for our governors of central bank, please. With all of the best wishes for all of the governors of central bank, of course, to maintain the price stability as well as also support economic recovery. Let's get down to what we left before. Sheila, 2 questions. Of course, IMF advice to countries will depend on country circumstances. No one size fits all. First question, what's the guiding principle so speak on monetary policy response? Of course, for front-loaded interest rate response. When the question is, when the inflation dominated by supply, will it need to be bringing back the real interest rates to be positively high? And of course, on the monetary policy mix, you talk about exchange rate intervention, capital flows management for the outflow you should talk about. I think what IMF advised on that. Second, you talk about the very important role of the IMF in this very global unprecedented challenges. What the IMF role on this, especially on the global financial safety net for those countries that actually need on global financial safety net. Sheila, please.
Thank you, and you are very right. Each country is very different. Circumstances are different. As I was mentioning before, some countries have very large public sector debt. Some countries have corporate sector mismatches. Some countries have local domestic markets which are much more deeper and able to weather this storm well. So I think, as you said, it's not possible to say here is the policy mix that works for everyone. But I think a combination of policies, given the different positions countries are in, is important. And in that context, really understanding the vulnerabilities, the leverages, hidden leverages or transparent leverages in the corporate sector, in the financial sector, in the non-bank financial sector is going to be critical to determine exactly how to use the different policies. And I do agree with you that, yes, it's very important, and Hyun mentioned this, I also mentioned it, the importance of using monetary policy, using it in a way that is preemptive and strong to anchor inflationary expectations. But that has implications for those parts of the households or corporate sector or the financial sector that are highly leveraged, less profitable, less liquid, and so on. So at the same time, taking macroprudential measures and the necessary either liquidation so we don't end up with zombie firms, which we did in many cases in the past, is going to be important. So monetary policy, foreign exchange interventions, where foreign exchange leverages are high, as well as, of course, the role of fiscal policy in making sure that those are most vulnerable are protected. I do want to mention one last point, which again, this was a lesson we learned too late in the global financial crisis, and that's the role of productivity enhancing structural reforms. You mentioned supply side issues. We are also going through a structural transformation, not just because of the pandemic exacerbated it, but it was even before the pandemic. So in terms of the digital, the way our economies work with the climate challenges and so on, there is a huge structural shift at the same time. And I think it's important to make sure that we don't forget about in the labor market, in the product market, to do the structural reforms that are necessary. Of course, this is easier said than done, especially with all the social tensions that are present and the electoral cycles and so on and so forth. But I do think a combination of these policies are important. In terms of the role of the IMF, we have been thinking very hard and learning also from the past in terms of, is our toolkit, in terms of IMF's own toolkit, lending toolkit, is it appropriate? Do we have the right tools, given that we have shock after shock, and some of the countries that we have programs with are hitting their access limits? They need more resources. So we have been thinking about how do we make sure that we use the flexibility in our toolkit, but also make sure that we think hard about, do we need new instruments? The Resilience and Sustainability Trust that we launched and many countries have generously supported in terms of rechanneling SDRs is an important new tool to address some of these structural challenges, and also the precautionary instruments in terms of the liquidity lines and the flexible credit line, which some countries have been using. So those are issues that we are looking very carefully now to see if we need to revise them going forward.
Thank you, Sheila. That's, I think, from the IMF. Yung Song, you talk about macro financial linkage. I know BIS has done a lot of job in also advising on the macro prudential aspect. Sheila already talking about monetary policy here, using different tools, to address different segment. Of course, the interest rate is the main instrument, but the other are complementing. But you had done so many works on the macro prudential aspect, which is probably also can address those segment of vulnerability, or even to support the financial system stability. Yung Song, please.
Yes, I think it's very important that we have an ex-ante perspective on this. So it's important that we fix our roof while the sun shines. So to some extent, it is very unhelpful when already the rain has started. However, I think it's important also to think about some of the logic that was underlying this more portfolio approach, this holistic approach. But I think one thing that's very important, and I would just like to underline something that Jayla said, is that the structural reform, growth-enhancing reform, I think has to be a very, very important pillar of the longer-term policy response. And it will also help us to actually navigate some of the current, sharper challenges as well. If we look back to what happened during the pandemic, clearly there were short-term supply disruptions that were very much pandemic-related. So either shipping disruptions or immediate health disruptions. There are also these very, very longer-term, the secular changes, which have to do with technology, demographic changes. Those are, to some extent, not amenable to short-term policy. But what's interesting and very important is for us to think about what's in the middle, which is which are the supply disruptions, which are the structural changes that are following, if you like, they are the consequences of the pandemic and the policy response, but which have a more lingering influence. And some of the events we have seen in the labor market, for example, I think do urge us to rethink, some of the ways that workers and firms, the whole, if you like, the relationships in the economy, they all interact. And I think it would be fair to say that there is, to some extent, a re-evaluation of the nature of work itself. Now, how do the complementary macro-prudential policies, factor into this? I think for the central bank, the use of the balance sheet during these very stringent periods, I think, will be very important. So, just as you would actually conduct monetary policy using the policy rate, also central bank balance sheet policies can be thought of as being the broader toolkit in this case. When financial conditions are very tight, then domestic currency monetary policy operations can have a very beneficial effect. Although there the fiscal element is going to be a very important constraint. And just as you would try to lean against the wind on the way up, you can then also turn on the tap on the way down, as it were. So, for example, if you have sufficient FX reserves, then short-term leaning against the wind of very adverse exchange rate movements could also be a very important pillar. But of course, that depends very much on how long that period of stress would last. But in a period when monetary policy is very much tied up in combating inflation, I think we have to bring on board these other complementary policies as really the second line of defense.
Thank you, Yung Song. Well, I wish I can bring Q&A to the floor, but I was the next session is about to begin. But before that, Sheila, you have a final remarks, and Yung Song, final remark, please, before we conclude this session.
So one thing I learned over these last 30 years is that when you have incredible periods of uncertainty, it's very important to do the contingency planning and make sure that and that's why I keep mentioning asset quality reviews or stress testing or monitoring as much as possible and taking early action. So I think not to be complacent and not to add to the uncertainties by some of these unexpected failures in the corporate sector or banking sector, or for that matter, non-bank financial sector. I think that's to sight of that is in my view the most critical element.
Thank you. Yung Song, please.
I think the one lesson that I have learned over the last couple of years is that while we are very accustomed to looking at the economy, looking at monetary policy through aggregate demand management, what we have seen this time round is that the supply side is incredibly important. And there we actually understand much less as to what the determinants of aggregate supply are. For example, the labor market, which is, still has some very mysterious elements still we need to understand. So as we look ahead, I think the longer term lessons have to do with how do we reinvigorate growth? How do we actually turn on the tap of aggregate supply that is much more than simply, well, let's operate on monetary policy tools to influence aggregate demand. I think we are too accustomed, perhaps, into thinking that if we take care of aggregate demand, then the supply side will adjust smoothly in the background. I think that is no longer the case. With also the rejigging of the supply chains, both due to the pandemic and also due to the shifts in the geopolitical scene as well. I think we're probably looking ahead to a period when the supply side will be a very important factor for monetary policy.
Thank you, Yung Song. So, ladies and gentlemen, what we learned from today, from this session? Let me just cite three to address those very complex global challenges that in front of us, especially the central banks. First, monetary policy need to bring back price stability to preemptively, forward-looking, addressing, averting inflation expectation. Of course, different countries have different pace, but this basic principle is there. Interest rate policy is the main response, but can be complemented by exchange rate intervention as well as capital flows management, especially for the outflow. At this juncture, especially for those emerging market and developing countries, the domestic effect market still shallow. Second, go granular, go micro on assessing corporate household balance sheet. This is very important so that monetary policy can be in footing with financial stability. On this aspect, of course, some of macro-prudential tool can be also be implemented. To be granular, to be also looking risk mitigation, as Ella mentioned, as well as Yung Song mentioned. Third, the supply side is important, especially this juncture, because the problem of price stability and those corporate vulnerability coming from the supply side. So coordination between central bank and the government important. Not only monetary and fiscal policy, structural reform. It's very important to address the supply side. The better we address supply side, as Yung Song mentioned, and Sheila mentioned, then actually the problem of the price stability can be not only well understood, well addressed. And the burden to the central bank monetary policy can be less. And most of all, we can bring back the price stability without, of course, have very determined impact to economic growth. I think that's the theme that Indonesia bring about under G20 presidency. With those policy advice in the global, especially IMF and BIS, but also integrating and coordinating the policy framework. Integrated policy framework of monetary from IMF, but of course macro financial stability framework from the BIS. Big applause to these two good speaker. And as a treat for you, my ladies, Sheila, my Young Song, let's make a photo first. Everybody silent. We want to make picture. Please picture, please.
Governor Perry, allow me to count down for the photo. We'll take a photo in 3, 2, 1. Okay. Ladies and gentlemen, let's give another round of applause.
Thank you very much. Thank you very much. Let's go to the next session. Tim, take from here.
Thank you very much, Governor Perry Warjio. Let's give another round of applause to our moderator and also to all the speakers, Governor Perry Warjio, Mrs. Pasar Basioglu, and also Mr. Shin for your insightful session. And as we have heard here, we have heard a lot of situations that we are facing, multiple challenges that you are facing, also faced by the central bank and shared by our speakers. And also in the closing, Mr. Perry has concluded to us the 3 points that we need to pay attention together as we step forward. Now, as I say, stepping forward, for this next session, ladies and gentlemen, we will be looking at the future. So let me just share here from the center of the stage here. In this next session is also an exciting session because we will be looking at the future. And before we start the session, we will see a performance from a group. This is a DJ, but as you can see, it's not just a DJ. We also have a sapek from Kalimantan. Now, there's a reason why we have a traditional instrument from Kalimantan, because if we're talking about the future, for Indonesia, the future is in Kalimantan, because we are in the process of shifting our capital to Kalimantan. So you'll be seeing a lot more of Sapek Kalimantan in the future as well. Now, performing to you is DJ Gustu and Sapek Kalimantan, and they will deliver us to our next topic in our session, which we'll be talking about central bank digital currency and crypto assets. So before that, let's hear DJ Gusto and Sapek Kalimantan. Let's give another round of applause to DJ Gusto and Sapek Kalimantan. Let's give a round of applause to DJ Gustu and music from Sapek, Kalimantan. That is a fusion between traditional music and traditional musical instrument with modern digital music from DJ Gustu. So that is the perfect tone to bring us to our next session here on today's Gala seminar, which will focus on central bank digital currency and crypto assets. Ladies and gentlemen, to start this panel discussion today, allow me to invite back on stage, this time to moderate our discussion, Mr. Hyun Song-shin, who is the BIS Economic Advisor and Head of Research with recent focus on digital innovation and the financial system, including the design of central bank digital currencies and their implications for users, financial intermediaries, and central bank. Ladies and gentlemen, excellencies, without further ado, let's welcome our moderator, Mr. Hyun Song-shin.
Well, it's a great pleasure to moderate this panel. I'm Hyun Song-shin from the BIS, and we have a very important and a very pressing issue right now, which is what's going on in crypto. To discuss the issues with crypto, their regulation, and the role of central bank digital currencies, we have an excellent panel. And I would like to invite the panelists to the stage before I introduce them. So Governor Philip Lowe from the Reserve Bank of Australia and Governor Thomas Jordan from the Swiss National Bank. Online, we're also joined by Eddie Yu, the Chief Executive of the Hong Kong Monetary Authority, and Tobias Adrian, who is the Financial Counselor and Director of the Monetary and Capital Markets Department of the IMF. What we will do on this panel is to review some of the recent events in crypto, discuss some of the implications for financial stability, for regulation, for their use, and within that framework also raise the issue of what role central bank digital currencies may play, both as an alternative to crypto, but also in the longer term. And I think what we've seen in the recent turmoil in the crypto universe is that some of the microeconomic mechanisms that have given rise to stress in the crypto universe are to some extent very familiar from stress episodes in conventional financial markets. So, for example, we have seen how leverage then turns to deleveraging and fire sales, exactly as we saw actually during the great financial crisis in 2008. We also saw the implications of maturity mismatch and how that can give rise to run-like phenomena in the crypto universe, again, just like what we would expect in the conventional financial system. And so the regulation of crypto is going to be, emerging as a very important policy challenge. And there, the principle of same risk, same activity, same regulation is a very important benchmark. But the same activity could mean either in terms of the contractual form, whether it be like a deposit in a crypto bank, or whether we should interpret same activity in terms of the underlying economic function. So in conventional financial systems, we compare, for example, the giving of mortgage loans by a bank and the way that mortgage-backed securities would perform the same economic function, but in the capital markets. In crypto, most of the assets within the DeFi, decentralized finance universe, tend to be other crypto assets, other crypto coins, and therefore it's a very different economic function rather than what we would expect in a conventional financial system, where there are lenders and borrowers and there are real assets involved. So how we apply the level of same activity, same regulation clearly will very much depend on that. Now, is financial stability the only issue? I think probably there are other important policy goals, such as consumer protection, for example, to make sure that there is that we can guard investors from deceptive marketing and misleading advertising and so on. In the context of all this, central bank digital currencies loom large, both as a digital asset that is safe, that is trusted, issued by the central bank. But there is a larger set of issues which have to do with the possible role of CBDCs within the broader payment system, both in the domestic context and also in the cross-border context. So what I would like to do is to ask the panelists to provide the initial interventions, and we will go in the order that we see here. So I will first start with Thomas Jordan, then to Phil Lowe, and then to Eddie Yu, and to Tobias. So Thomas.
Thank you, Yoon. Well, let me start by thanking the Indonesian presidency, and in particular my friend, Governor Perry, and the Bank of Indonesia for organizing this seminar. It's really a great pleasure for me to be here and to share some insights on CBDCs and crypto assets from the perspective of the Swiss National Bank. Well, the topic is very timely and important. In recent months, crypto assets have experienced a serious setback. The overall market capitalization has decreased by more than 60% from the peak in 2021, and crypto markets are experiencing severe stress. Some so-called stablecoins and crypto service providers have run into difficulties. Indeed, people who have invested their life savings into crypto assets are now facing heavy losses. For many observers, these developments have not been entirely surprising. Structural flaws in crypto assets have been evident for quite some time. From a central bank perspective, the main concern is that these stresses in crypto markets could spill over to traditional finance and negatively impact financial stability. So far, this has not been the case, but risk should not be underestimated, as developments in crypto assets can be very rapid. Today, I would like to point out 3 lessons learned from these recent developments. First, for regulation of crypto assets. Second, for the role of central banks in the monetary and payment system. And third, for central banks' explorations of CBDCs. So let me start with the regulation and supervision of crypto assets. Digital intermediaries and crypto assets aim to cover the entire spectrum of activities currently provided by the traditional financial service industry. These include payments, raising capital, savings and investing, and lending and borrowing. But the recent events show that the crypto financial system also exhibits the same risks as in traditional finance, such as the leveraging, interconnectedness, contagion, runs, fire sales, and also fraud, evasion, and even manipulation. Now, in response, public authorities are stepping up their regulatory and supervisory efforts. The authorities have made it clear that crypto assets and the provision of digital financial services more generally must be brought within the regulatory perimeter. The application of existing regulatory standards, according to the same activity, same risk, same regulation principle, and you already mentioned that, must be the starting point in this regard in order to achieve the same regulatory outcome. In order to apply existing standards, it is important to categorize crypto assets, but also related activities. For example, a debate is currently taking place about whether stablecoins and their issuers should be regulated as money market funds, as payments system, as deposit-taking institutions, or as a combination of these. This categorization is relevant as it determines what approach is adopted to mitigating run risk and promoting stability. More generally, the categorization will be important to determine how the same activity, same risk, same regulation principle should be applied. Of course, and you also already mentioned that, some adjustment may be needed when applying standards in order to factor in the unique features of crypto assets. Many crypto arrangements are borderless by nature, and some of them lack a clear legal entity that can serve as a regulatory entry point. Such arrangements challenge our traditional domestic structures for regulation and supervision. I'm convinced that close cooperation is the key to designing crypto asset regulation that allows us to harness the benefits of these new technologies while mitigating the related risks. The Financial Stability Board is playing a critical role in coordinating regulatory efforts between domestic authorities and international standard setters, and has recently communicated its stance on the regulation of crypto assets. Developing a sound regulatory framework for crypto assets should not be seen as an impediment to innovation. Rather, it will help to avoid regulatory arbitrage and facilitate the adoption of new technologies. Let me now turn to the second lesson learned. The stresses in crypto markets remind us that the role of central banks in the monetary and payments system remains as relevant as ever. Let me elaborate. Stablecoins perform an important function in the crypto ecosystem as a bridge between crypto assets and traditional finance. Stablecoins import the stability of an established unit of account. To put it in another way, they leverage the credibility of sovereign currencies into the crypto world. However, the demise of Terra and the difficulties faced by other stablecoins have shown that stablecoins are prone to run risks when users lose trust. Also, stablecoins are highly concentrated today, and there is the risk that stablecoins arrangements are fragmented in walled gardens. This is a reminder that central banks are uniquely positioned to play a or even the critical role in the monetary system. They issue central bank money, which defines the unit of account and which is used to settle transactions between financial institutions on a trusted payment infrastructure. This payment backbone establishes a level playing field for private firms and facilitates private sector innovation. Many central banks, including the Swiss National Bank, are in the process of upgrading these payment systems to enable faster payments between individuals. The results have been very encouraging. For example, in India and Brazil, where upgrades have helped to reduce fees and improve financial inclusion. This modernized payment system can also be linked across borders. This could contribute to the G20 initiative on improving cross-border payments. This brings me to the third lesson, which concerns digital money issued by central banks or Cbdc. The flaws in crypto markets should not lead us to dismiss the innovative potential of technology behind crypto assets. Actually, many central banks are exploring how they can harness the benefits of the technology for the introduction of Cbdcs. The Swiss National Bank has been focusing on wholesale Cbdcs. These are Cbdcs which would be available to financial institutions that already have direct access to reserve accounts and central bank payment systems. Potentially, such access could be expanded to regulated financial institutions from abroad and also to other payment service providers. We have explored domestic and international use cases for wholesale CBDC in experiments conducted with the BIS Innovation Hub. We found that settling tokenized assets and cross-border transactions with wholesale CBDCs is not only technically feasible, but also efficient. However, our experiments also show that the most important challenges are of a legal, governance, and policy-related nature. Central banks will have to carefully evaluate the policy implications of CBDCs for monetary and financial stability. These implications will depend heavily on a specific CBDC's design. To be useful, CBDCs will also have to be embedded in existing payments and settlement infrastructures and markets. More generally, the cross-border use of CBDCs should have implications or could have implications for the international monetary systems, and these need to be better understood. I'm sure that Tobias will go into that. Whether central banks will eventually decide to introduce a CBDC, either for retail or wholesale purposes, will depend, among other things, on developments in traditional payment systems and in private digital currencies. In conclusion, let me emphasize that it's important to bear alternatives in mind when examining the case for a CBDC. While some central banks may decide to issue a wholesale or retail CBDC, others may opt to improve traditional payment system instead. Thank you.
Thank you very much, Thomas. You've given us a lot of food for thought, and we will come back to those. Let's move to Governor Lowe. Phil, the floor is yours.
Thank you very much, Sean, and thank you very much to my great friend Governor Perry for the invitation to be here today and for your fantastic hospitality in Bali over the last couple of days. It's been a real pleasure to be here. As Thomas said, the questions you've set for us in this session are really timely and they're important, but they're also really hard. What's the future for central bank digital currencies and crypto, and how should they be regulated? But because they're hard, my instinct is to look back at history to see whether there are any lessons for us. And when I do that, I found three lessons that are relevant. The first is that what our societies use as money is determined by the technology we have at hand. Once upon a time, we used gold and silver coins. Then we used paper banknotes. In Australia, we use fantastic polymer banknotes. And most money today actually is digital. It sits in bank accounts and it can be moved between bank accounts instantaneously. So the nature of money changes with the nature of technology. The second observation from history is that privately backed money can work for a while, but it usually ends in disaster. It usually ends in financial stability and a loss of confidence. People value money backed by the state, whether it's banknotes issued by the central bank or deposits in private banks underpinned by government-endorsed deposit insurance. And in wholesale markets, financial institutions want to settle in central bank money, not in private money. They value safety, stability, and finality. So public money is generally preferred to private money. A third lesson from history is that new technologies drive waves of innovation, but they also drive waves of speculation. And those waves of speculation often end up in people losing money, particularly people who are not well informed. I think we've seen examples of that just recently. So they're the three lessons from history, and I've been thinking about how to apply those to the difficult questions that we have to consider today. I think it's pretty clear that new digital technologies will once again change the nature of money in our societies and how that money is transferred. No doubt there's more innovation to come and we need to be prepared for it, but it's at this stage I find it really hard to know exactly what the future is going to look like, especially in countries like Australia where we already have a very fast, real-time, flexible payment system where money is moved instantaneously between any two bank accounts in the country. The system meets the needs of most people, and we're seeing really good innovation in an Australian domestic fast payment system that meets the needs of most people. But it's certainly possible that new forms of money will develop. If they do, they're going to need to provide better services than the payment system we already operate from bank account to bank account. And it's possible new forms of money will do that, offer better financial inclusion. Not everyone has a bank account. And the cost of payments to merchants is still very high. Credit card payments are very expensive for merchants, and even debit card payments cost merchants a large amount. And as we all know, the cost of cross-border payments is really high. So new forms of money can help here. And I think it's also quite possible that new forms of money will offer better consumer experience than passing pieces of paper or pieces of polymer around or moving money between bank accounts. So it must be the case that new forms of money will emerge that offer better solutions to the ones we have now. In particular, I think it's probable that at some point the banknotes that we hold in our physical wallets will be complemented by some form of digital token that we hold in a digital wallet. And if this is how things evolve, the question we've been thinking about is what should be the nature of those digital tokens in the digital wallet? My view is that if these tokens are going to be used widely by the community, they're going to need to be backed by the state or prudentially regulated, just as we regulate bank deposits. At a really high level, I think you can think of two possibilities here. One is that these tokens are backed by the central bank. So they're a central bank digital currency that's of retail form. So that's one possibility, and some of us are exploring that. But the other possibilities that we're exploring is that these tokens are issued by the private sector, not by the central bank. But the tokens are backed by very high collateral, perhaps central bank deposits or government securities, or that the issuing authority is actually regulated like a bank. So there could be private tokens rather than a central bank digital currency. Both possibilities can obviously work. I tend to think that the private solution is going to be better if we can get the regulatory arrangements right. That's because the private sector in the end is going to be more innovative than the central bank. It's going to be better at innovating and designing features for these tokens. And there are also likely to be very significant costs in the central bank setting up a digital token system. I think it's going to be better for the private sector to manage those costs. There are also quite a lot of risks here and operational issues. Thomas was kind of referring to these with at the wholesale level, but if the central bank were to issue tokens that sat in digital wallets, just as we issue banknotes in our physical wallets, there are a lot of operational issues, there are a lot of risk management issues, privacy, AML, there's a long list. In the end, I think the private sector is going to be better at doing that than the central bank. But if we are to have a system of privately issued tokens, then the regulatory system needs to be really strong, and I don't think any country has a sufficiently strong system at the moment. In Australia we don't. We're looking to put in place it, but we're still not there. People need to have confidence in these tokens. They need to be confident that they're going to be repaid, and they're going to need to be confident that tokens aren't counterfeit, just as they need to be confident that banknotes aren't counterfeit. It'll also be important that these tokens are interoperable, just as you can use a bank-issued card at any terminal in the country and move money between any two bank accounts in the country. We'll need these tokens to be interoperable, so that a token issued by one bank can be used at another bank. So in my view, it's still too early to know whether central banks should issue a retail central bank digital currency. It's possible, but it may well be better and more efficient to have these tokens issued by the private sector. I feel like there's a stronger case for central banks to issue a wholesale central bank digital currency, and Thomas talked about this. These wholesale central bank digital currencies could be a useful complement to our existing RTGS systems. We're exploring with various entities how they could be useful in the settlement of trade flows, in cross-border payments and syndicated loans. And they could also be helpful in developing new markets for tokenised assets. One example that people in Australia are exploring is tokenised assets of mineral resources in the ground, and that somehow a central bank digital currency at the wholesale level could help in trading and development of those markets. So I think it's quite likely that in time we will issue some form of digital currency for wholesale settlements and will complement the RTGS system. The third lesson from history that I mentioned at the outset was that periods of innovation tend to be associated with periods of speculative behaviour as people fear missing out on the next big thing. And I think we've seen this recently with some of the speculative interest in crypto that's not backed by any particular asset. Now, I really hesitate to use the term cryptocurrency, as most crypto doesn't have the characteristics of a currency. It's not low cost, it's not widely accepted medium of exchange, and it's not a reasonable store of value. We've just seen 70% declines in value, so I don't think we should be talking about cryptocurrencies. In fact, many examples of unbacked crypto seem to be little more than forms of speculation to me. The crypto provides very little utility to its owners, other than the ability to sell the crypto to somebody else, hopefully at a higher price, or to buy another form of crypto. So the underlying utility, at least for many of these crypto, I don't like using the word assets, but because I don't think they're assets either. So we can't rule out the possibility that people will eventually find using these various forms of unbacked crypto useful for making everyday payments, but I'm really sceptical that they will. Most of these crypto examples, the prices are volatile, and there's quite a lot of problems with the scalability of the technology. They can be used in small closed-loop systems, but there are problems. So I think it's unlikely that these various crypto things, not assets or currency, will be used as a form of money. But if they did, then we'd have to be confronting a whole series of very difficult issues. So I don't think that we should be thinking of currency or assets, but they do need regulation. And I think the main focus needs to be on consumer protection. People need protection, they need education, people need to understand what they're buying and what they're not buying, and that they're protected from scams. We need to deal with AML issues, which are really serious in this space, and we need to deal with privacy issues. So there's a lot of consumer protection issues to work through, and we also need to understand the implications for broader financial stability. I know this is something that the Indonesian G20 presidency is focused on. We need to understand. At the moment, I'm not particularly concerned about it. My main concerns are really consumer protection and making sure that people who are not particularly well informed don't lose money. The final point I wanted to make is that the one piece of the crypto landscape where I think there is real promise is in stable coins that are linked to the value of our national currencies. I think it's quite possible that these stable coins will form the basis of privately issued tokenised money. If that's how things develop, I think it's quite possible, then we need to have a first-class regulatory regime where these stable coins are effectively regulated like bank deposits. We regulate private money in banks. We should ultimately regulate private money that's a stable coin that sits in our digital wallets as well. Thank you very much, Sean.
Thank you very much, Phil. So let's now move on to our two virtual participants. We'll go first to Chief Executive Eddie Yu. So Eddie, over to you for your opening remarks.
All right, thanks, Ewan. First of all, I would like to thank Perry for the invitation. I very much would like to be in the beautiful island of Bali, but unfortunately I can't. And today I would like to focus my comments on three main areas. One, the risk brought by cryptos or crypto things, as Phil said, and also DeFi. And second, how we should manage the risk through regulation. And thirdly, the role of CBDCs in all these new developments. But I would like to say, I would like to start by just saying that despite the Terra Luna incident, I thought that the crypto or DeFi developments won't just diminish. They might be held back, but they won't disappear because the technology and the business innovation behind all these developments are actually likely to continue and will grow further in our future financial system. There are many benefits brought by DeFi before I talk about the rest. Let's say permissionless and non-custodial means that you can potentially cut out the intermediaries and cut costs. The composability feature means that you can actually build what you want just based on others' work in an open source environment and innovate, thereby promoting innovation and use of new services. But of course, despite these benefits, there are new risks. And Phil and Thomas has talked about some of them, like market integrity, including AML, fraud, investor protection, etc. Like the financial stability risks of these DeFi platforms, including the familiar run risk or leverage risk. But there are also new risks coming out from these platforms, things like the coding and cybersecurity risk because of the extensive use of smart contracts. And also there are concentration risks because despite what the name suggests, the decision powers is actually very often concentrated in a few nodes operated by a few entities like the validators or those holding the governance tokens. But the third risk is something that I'm more concerned about, which is the potential spillovers to the financial system. This risk arises from the increasing connectedness between the DeFi cryptos and the traditional financial market. And the spillover can come through two channels, stablecoins, which serve as a bridge between DeFi and traditional finance, or it could be through banks, which provide financial services to the crypto companies and also acting as the direct linkage between the crypto wallets and the bank accounts. So despite the fact that crypto and DeFi has a lot of benefits and they will bring about financial innovation, it's important that we also need to manage those risks through regulation. And there are two areas that you can regulate. One is on-chain activities and the other is off-chain. The latter off-chain activities is actually a lot easier. And this is where I suggest we can start with in four areas. One is the asset itself, for example, stable coins, which Thomas and Phil has talked about in terms of the great need for regulation, and I won't repeat. Second is the trading platform or some of the centralized exchanges, which is where crypto interacts with the investing public very often, things like Coinbase or Binance. And I think that they should be regulated. In Hong Kong, we will soon have a new legislation regulating these trading platforms, both from the AML CFT perspective and also from market integrity angles. But we need all other jurisdictions, major centers, to have similar regulations because these platforms and operators are extremely mobile. They can go from Hong Kong to Singapore to London or to Cayman Islands in one go. The third area is the interface with the regulated financial entities, including banks, or the so-called on-ramping and off-ramping activities, where banks should be required to manage the risk from both direct exposures and also when they provide services to clients, or even in trading or custody in both crypto and DeFi. And of course, fourth and final is investor protection, including the need for suitability tests when banks are selling crypto-related products to their customers, or even restrictions on advertising to retail investors. But down the road, regulation has to be extended directly to some of these DeFi platforms, although it's very challenging because of the decentralized and globalized nature of these platforms. But it's necessary because, like what I mentioned earlier, the decision powers are very often very concentrated in a few entities, validators, developers, or governance tokens holders. And we need to find a way to creatively find a way to identify and regulate these entities or people in a global way. So we need a very globally coordinated approach in order for regulation to be effective. And I've talked quite a lot about the need for regulation, but we should understand and appreciate that the DeFi and the blockchain protocol can also inspire financial innovation, not just in DeFi lending or yield farming, which only service the crypto industry. But in time, I think it will potentially offer innovative solutions relating to activities in the real world or traditional finance. For example, the blockchain technology can allow the use of smart contracts to execute payments for bonds or other financial assets in future, especially if they are tokenized. And it could also allow the fractionalization of asset ownership, for example, in art, in real estate, or in other traditional assets. And if we believe that cryptos and DeFi ecosystem will continue to develop, a further question to ask is whether DeFi or crypto development will be better or worse off with sovereign money in the form of Cbdc. And for that, my answer is that it will be better. For DeFi to develop or even become more mainstream, I think three elements are needed. One is a more robust and mature underlying technology. Second is innovative business solution. And the third one is, very importantly, trust in the platforms. And I will argue that in money and payments, central banks remain the best placed institution to provide the trust even in this new age. And as in traditional finance, private or commercial money will always have to find a way to connect back to public money. And because after all, trust is the foundation of any financial platform. So public money or the ability to be converted back to public money can carry that trust through good and stressful times. And as I mentioned earlier, DeFi currently has two channels to connect back to traditional finance, stablecoins and banks. But in fact, if you think about it, for these on-ramp, off-ramp activities, Cbdc could, in theory, make it easier and also provide more confidence for users if it were to serve as a link or bridge. The use of Cbdc can also build in stability for these DeFi ecosystem, avoid the systemic stress that may be caused by the failure of any major private money provider. And that in turn could provide more comfort for regulators who are concerned about the spillover effect of DeFi to traditional finance. But I can, of course, understand that from the perspective of those operating in the DeFi world, they may be a little more skeptical because the idea of decentralized finance is not to have any centralized payment authority. They thought that it might stifle innovation. They thought that it might take away some of the features that they like in DeFi, like anonymity, because if Cbdc and traditional or central bank instruments were to be used in these platforms, there will be AML requirements. It's still very early days and DeFi space still needs to mature, and CbdCs are only still being explored by central banks. Although I would say that the Cbdc projects that we are exploring through the BIS Innovation Hub fits very well with the current developments in DeFi platforms, including, for example, under Project Gala that SMB operates. It involves wholesale security settlement, asset tokenization under Project Genesis, or the use of DLT or Cbdc for cross-border payment under Enbridge that the HKMA has participated. So overall, I do see a lot of benefits to integrate the Cbdc developments into the involvement of the crypto and DeFi platforms, provided that the risks arising from these platforms can be properly managed, which in turn will depend on the evolution of the regulatory landscape for DeFi. And this last point is very important because if we allow Cbdc to be used in some of these platforms, we might run the risk of actually being seen as legitimizing or even endorsing these platforms, where if they're not properly regulated, illicit activities will happen, or where investors might suffer very huge loss. Again, it's still very early days for both DeFi and Cbdc. While I talk about the need to properly regulate crypto and DeFi, and also to explore the use of Cbdc, I should say that it's actually extremely challenging to get the balance right between regulation, when and how and what, and also between regulation and the need to promote innovation. If we regulate too soon, central banks could be criticized as stifling innovation in the creative space. But if we regulate too late, investors might get hurt and lose money, and some of these platforms might get too large, and it becomes quite difficult to regulate. And the how is also difficult because we need to find ways to effectively regulate DeFi. How can we drive a globally coordinated approach in order for that to be effective? And for CBDCs, should they be used to complement all these new developments? Or as I said earlier, will we be seen as legitimizing some of the platforms that offer highly risky products to the public? So these are all open questions that we should collectively think about on how best to proceed. And these are already pursued in some of the international platforms like the BIS, the IMF, and also the FSB. And I think we need faster speed in deliberations and also more conviction in really collectively putting some of the recommendations like stablecoin regulation or central exchange regulation, put them into implementation, put them on the ground, and not just about discussion. And that will actually enable us to catch up with the speed of development in these fast emerging platforms. So I'll stop at that. Thank you very much.
Thank you very much, Eddie, for those very insightful remarks. So let's go to Tobias for your opening remarks. Tobias, thanks for joining us so late in Washington.
Well, thank you so much, Hyun, and let me thank Governor Perry and the Bank of Indonesia for this wonderful event. I apologize for not being able to participate in person. I would love to be there with you. I will focus my remarks on central bank digital currencies, policy objectives for CBDC design, cooperation among central banks, and then I would say a little bit about what we are doing at the IMF. In terms of policy objectives, in our view, there's no one-size-fits-all for CBDCs. There are many different policy objectives that can be pursued with CBDCs, and different countries have different levels of payment systems and digitalization. So, some example of central bank objectives for CBDCs are increasing financial inclusion, promoting competition in payment systems, or enhancing cross-border payments. And so depending on the technological state of a country and the policy objectives, the design of CBDC across countries could be quite different. In general, we feel that the central bank has to work closely together with the private sector, and there has to be a good understanding of what is the role of the central bank versus the private sector. For example, it must be very clear who does what and how it is being done in a safe fashion, such as who's operating ledgers and updating ledgers, how is user acquisition being governed, who does KYC, customer due diligence, how is governance defined, what is execution, and what is oversight. So many details are to be sorted out by each country. Central banks will have new roles. CBDCs challenge central banks as they get potentially closer to households and corporations in terms of interacting with them. Central banks should design CBDCs in a dynamic way with new features, technologies, and use cases, even after going to production. But of course, central banks have traditional roles to play as well as guardians of the safety of the financial system and the payment system. We are in favor of establishing multilateral platforms for CBDCs across border. And Eddie already talked about some of the experiments that the BIS is doing together with central banks on developing such platforms. The objectives are to overcome settlement risks, shorten transaction chains, lower FX conversion costs, and reduce compliance costs while preserving data sovereignty. Multilateral platforms for CBDCs can be leveraged to improve economic outcomes. Increasing access to the new platforms and leveling the playing field may yield competition and lower costs. Multilateral platforms are not per se about technology, or not just about technology. They are really about market design, risk management, and safety nets features, as well as, so the governance around these platforms is extremely important. So setting up governance, harmonizing domestic rules and legislation, as well as working with the political economy in each country are first order challenges here. But public policy should develop ambitious solutions. Cooperation among central banks and international organizations will be fundamental to achieve this. Let me now turn to strengthening cooperation among central banks on CBDC. CBDC development should be a collaborative process among central banks. Two areas where collaboration among central banks is needed the most is including these multilateral platforms, but also CFMs. Capital flow measures are extremely important for many countries, and CBDCs have to be compatible with these CFMs. But there are additional aspects: developing CBDC technologies and sharing lessons. But CBDC objectives and design will be different in each country. The costs of building up CBDC will be lower if done together. CBDC technology should be seen as a public good that could be tailored to each jurisdiction. One could think of setting up CBDC with a modular design, a core determining how issuance and transaction works could be developed commonly among countries. Sharing lessons on what works and what does not, how to incentivize the private sector, and what frictions may be more important, how to overcome hurdles, and how to manage risk can be beneficial to all. Cooperation is a must. We are looking into this, but I think there might be other solutions than cooperation on CBDC development. Let me finish with some thoughts on what the IMF is doing in particular in the area of CBDCs. The fund has a mandate to ensure domestic economic financial stability in the member countries and the stability of the international monetary system. And of course, the payment system is at the foundation of the international monetary system. We need to make sure that we achieve the mandate of global international monetary stability as we're transitioning to the digital economy. The international monetary system is facing fragmentation risks that need to be addressed. Risks are in part due to geopolitical factors and in part due to the fragmentation of cross-border payments, as well as the rise of digital money in and of itself. The payment infrastructure allows capital to move and currencies to be converted across borders, and thus underpinning global integration in the stable, efficient monetary systems. Hence, institutions such as the IMF or other international institutions such as the BIS and FSB that were already mentioned are working very much together on policy developments, together with the central banks, on policy developments on CBDCs and how these CBDCs are interacting internationally. In addition, the IMF is providing technical assistance to many countries around the world that have asked for assistance in terms of thinking through policy issues and thinking through design issues. And we are also doing surveillance, both surveillance at the country level on payment systems and CBDCs, as well as at the multilateral level. So let me stop here and turn back to Hyun.
Thank you very much, Tobias. I think we've had a very wide-ranging set of initial comments. What I would like to do now is to turn to the panelists and ask them to address two sets of questions. The first one is on crypto, and the second one is on CBDCs. With respect to crypto, and I will ask the same question to all the panelists. And ask them just to pick and choose elements of the questions. I guess with the regulation of crypto, One issue is whether regulation itself is going to legitimize the whole the universe. I think Phil raised the issue of how we should call them, but I think crypto is a good terminology there, Phil. And I guess to the extent that we regulate them, there are lots of different entry points. So one way, for example, as Eddie mentioned, was to actually regulate the on-chain activity itself, or it could be other entry points through exchanges and other intermediaries, in the crypto universe more broadly. Or should we focus much more on the points of contact between the crypto universe and the conventional financial system? One very important issue that Phil raised was the role of stablecoins. How should stablecoins be regulated? I think we heard Phil's approach to that question. And I think we'd be interested to hear the other panelists as well. So let's start in the same order that we had the opening intervention. So Thomas, let's start with you.
Well, thank you, Yoon. Well, I probably shared the view of most of my panel colleagues that the right point would be the activity to activate and not only the contact point. Well, just to give you an example, if you accept deposits or if you provide loans to somebody else, the regulator will come immediately and tell you, you fulfill all the conditions to be a bank, and then you have to fulfill the capital, liquidity, etc., all this kind of regulation. So when you really would like to enforce that same risk, same activity, same rule principle applies, then we should go after the activities. And if some activity look like taking deposits or look like making loans, etc., then a very similar approach would be possible. And we cannot say, well, because we are completely different, because we have a different technology, for us, the regulation doesn't apply. So we should be regulation neutral, really look at what is the economic activity, what is the economic sense, and then try to adopt that to that. And that brings me to really the stable coin. So I share Phil's view. If it's really something that is almost the same as a deposit, if it looks like a deposit, then it should be regulated as a bank. It could be in some jurisdictions that it looks more like a money market fund. That we do not have that in Switzerland, so I'm not familiar really with that. But I really believe that if it is as a deposit taking, then it should be regulated as deposit taking. So we do not give any regulatory advantage to anybody that just uses another technology.
Thank you, Thomas. Phil.
Well, on stable coins, if they're stable in terms of our national currencies, then I think they should be regulated like bank deposits. Or they should have very strong collateral requirements, with collateral being at the central bank or government securities. So I think they're fairly easy to deal with. The other crypto things who have variable prices go up and down, they shouldn't be viewed as currencies, and we shouldn't regulate them like currencies or bank deposits because they're not that. But they do raise very significant consumer protection and AML issues, and I think that's where the focus needs to be. As you say, the on and off ramps are important for AML and also important for consumer protection. So if people end up wanting to invest in these, invest is a weird word here, but buy these things that his prices go up and down, people should be free to do that, but they should understand what they're doing, and they should be protected against scams and criminal activity. That's where the focus needs to be, on the things whose prices move up and down.
So Phil, if I may just have a follow-up, actually. I think you made a very important point, which was on the self-referential nature of some of the crypto activity. So DeFi very much is about if you like, crypto activity, buying and selling and lending and borrowing other crypto coins. So I guess one concern that I've certainly heard from some quarters is that if you start regulating them, you will actually give them more credibility, you will legitimize, and so something which is half-baked would actually be more harm than good. Do you have a view on that?
Well, if we start calling them currencies, then I think that's counterproductive. If we start treating them like currencies and regulating them in the same way as currencies, I think that's problematic because they're not that. They're not backed by anything. They're not backed by a central bank, and the price moves around all the time. But that doesn't mean we shouldn't regulate them because people have an interest in buying them. The prices go up sometimes and they want to buy them to benefit from the capital gains and perhaps sell them to somebody else. So like any asset in our economies that people trade, there needs to be regulatory arrangements to protect people and to make sure that there isn't criminal activity as well. So that doesn't give them any legitimacy as a currency, but we do need to protect people and provide the infrastructure if people do in the end want to trade these instruments.
Thank you, Phil. So let's move to the virtual participants. So Eddie, could I ask the same question to you?
On stablecoins, same answer. I think same rate, same regulation. And depending on how they're structured, it could be like money market funds, tokenized deposits, or just instruments. You can use different regulations to regulate them. But what we are also doing currently is to see whether there still could be gaps because they can be structured in a very flexible way. So will there be gaps? Will they be able to evade from the current regulations? Do we need an overarching law so that we have more flexibility to capture all stablecoin-like new instruments? This is what we are looking at. As to the approach, as I said, I think it's much easier to start from off-chain, which means, like what you said, the interaction between crypto and DeFi with investors and the public, whether you're talking about centralized exchanges, the interaction with banks or investor protection, even advertising. These are areas that we can have a handle or we know how to regulate. For example, centralized exchanges is a new area, you need new law, but it's the same way that we regulate other trading platforms. Down the road, like Phil said, I do think that we need to regulate the DeFi platforms early rather than later. The main question is how. That is actually very challenging because it's the nature of DeFi is that it's decentralized and you need to identify who is in control and they can go from one jurisdiction to the other. So it's really the how that is a bit puzzling for regulating on-chain, but it's an area that I think collectively we should discuss a lot more in the international forums.
Thank you, Eddie. Tobias, do you have a quick answer to this before we go to the second round?
Yeah, very quickly. So I fully agree that the stablecoins have to be regulated either as banks or as money market funds, depending on the structure. There are different types of structures in stablecoins, but there are certain ones that are bank-like and there are tokenized deposits as well. So, different countries have different approaches. Some have literally banking licenses, others have payment licenses that are very similar to banking licenses. On crypto, I think the challenge is that crypto was never conceived for policy purposes. If anything, crypto was conceived to undermine central banks and to be remote from the government. And that is the fundamental challenge in regulating crypto. So I think the approach that others have discussed of regulating the financial market infrastructures that allow access to the crypto universe, I think this is all we can do at the moment. And I think that's exactly the right step. And that is in line with what is discussed at the FSB. Finally, let me just say that the Cbdc is really an opportunity, not just to have digital money in terms of a new technology, but really to use technologies for public policy purposes as opposed to crypto. Let me stop here.
Thank you very much, Tobias. Now, moving on to CBDCs. So, Thomas, you mentioned Project Jura, which is the project on multi-CBDC platforms between the Swiss National Bank and the Banque de France. It's one of the BIS Innovation Hub projects. And Eddie, in the Hong Kong center of the BIS Innovation Hub, we also have a multi-CBDC platform called Project Enbridge. If I may ask the two of you, what lessons you have learned from the experiments using those? I think that would be of great interest. And to Tobias, I would like to ask you, from the standpoint of the IMF, what can the multilateral institutions like the IMF and the BIS do in this sphere, in providing, if you like, the basic infrastructure? So let's go first to Thomas.
Thank you, Yun. Well, we had many lessons from this very interesting project, Jura, that we made with the Banque de France. Well, we saw that it's technically feasible. We still have probably to figure out whether the robustness is here, or also the scalability. But I would like to mention one point that is really important. So economics and legal issues remain extremely important. So at the end, it's the question whether we are comfortable having a platform where two legal systems are on this platform, whether we accept all these counterparties also as a counterparties at the bank, both at all these central banks. So it's very similar to grant access already today to foreign banks to your payment system. So all these questions are also today already relevant, independent really of the technology. And at the end, it comes always to the point that it's very similar to corresponding banking. And also, if you have tokenized the system, at the end, you have really something that comes close to a counting-based system, because we know exactly who owns the money at a certain point of time, and then the differences becomes relatively small from an economic and legal point of view. Of course, the technology is different. So all these legal and economic questions remain crucial at the end, whether we can go in that direction or not. Thanks.
Thank you, Thomas. Let's move to you, Eddie. The lessons from Project Enbridge.
All right, thank you, Hun. For the Enbridge is already now gone past the proof of concept stage, going into a pilot stage using live and real transactions from 19 participating banks about trade settlement. There are two lessons that we've learned through the process. One is the importance of interoperability. Technical interoperability is easier, but it's important because if you want more central banks to join to create that network effect, you need the platform to be able to connect with the others. For the Enbridge, the technology is designed in a very flexible way so that it can actually connect with other CBDC platforms, any CBDCs, or even if a central bank doesn't have a CBDC platform, the Enbridge platform can be connected with even the RTGS and the faster payment system of individual jurisdictions. So it's flexible enough. But what's actually more difficult is the business interoperability area, which involves harmonization or at least discussion on governance issues, regulatory compliance like AML, capital control, where different jurisdictions may have different requirements. This is a more difficult part. But what we found actually coming into the live transaction part is that there's a lot of business and policy decisions that you will need to think about when you're really dealing with real transactions. Things like, for example, who will provide liquidity into the platform? Is it the central banks for their own currencies? How can we ensure sufficient liquidity in the FX platform if it's done on-chain? Or whether to allow non-resident banks to access domestic RTGS in order that we can cut out some of the correspondent banks in between to save costs. And there are also business issues like how to break the inertia in terms of using current legacy system. How can we incentivize both the banks and their corporates to use platforms like that? So that there's a lot of real issues that you have to tackle when it comes to moving the platform into a stage where you're closer to MVP and commercialization. So I think the Enbridge project holds great promise in making cross-border payment faster and cheaper in future, in solving this long-standing pain, and also not only addressing this current pain, but also serving as a foundation for future payments. But there's quite a lot of business and policy issues that we need to carefully think through when we progress with the project. Thank you.
Thank you very much, Eddie. So Tobias, what is the appropriate role for the IMF and the BIS?
Well, I think that the BIS and the IMF are very complementary. We work very closely together, of course, on these policy issues. And the institutional characteristics are complementary. So, for example, BIS is really the central bank of central banks, while the IMF also has the finance ministries in its board. So for some questions, some questions about CBDC design, for example, these are broader questions where the finance ministries have a first order say, while other questions are narrower and are more targeted to central banks. Secondly, of course, the IMF is very much focused on policy development, surveillance, and technical assistance. And the bilateral surveillance, such as FSAP, so Article 4s, and the technical assistance are something that is fairly unique to the IMF, while the policy development is shared together with the FSB and the BIS. And of course, the BIS is running technological experiments, which the IMF is not doing. So I think we all have comparative advantages. We work together, we work very closely with the membership. And I think the punchline is always that we are working to help the membership, right? And to make to have countries make the right choices, the right policy choices going forward.
Thank you very much, Tobias. We could have gone on for a much longer time, but I see that our time is up. It's been a very rich discussion, and I'd like to thank all the panelists, and we should all give them a great round of applause. Thank you very much.
Thank you very much to our moderator and panelists. If you may please be seated, let's take a photo with also the... if you want to stand, it's okay, but let's be seated. Thank you very much. And we'll take a photo also with those joining us online. Let me count down for the photo session. We count to 3, 2, okay, 3, 2, 1. All right. Thank you very much. Once again, let's give another round of applause to our moderator and also to our speakers today. Thank you very much. And yes, you may please be seated back in your seats. Ladies and gentlemen, Excellencies, we have heard through this session the rapid development on crypto assets bears the question on how it will be regulated. And we're very excited to see a very lively discussion about the approach, and we are lucky to hear the different perspectives that we have heard in this session to help us formulate those regulations and also to create a framework, especially on CBDC. So that was our session, and it has been an exciting session and a very useful one. We hope that that has been insightful to everyone here. And as we move on to our next session, ladies and gentlemen, so thank you very much for staying with us in this Gala seminar. We are moving on to our next session. But before we continue to our final session in this Gala seminar, we want to present to you a last special performance. Now, this group of performers, they came from the eastern part of Indonesia. Through their dance and also the music, they represent the rich culture of the eastern part of the country. Now, in today's performance, ladies and gentlemen, they will showcase the abundance of new and renewable energy and what we have of new and renewable energy here in Indonesia. The essential factor, as we know, this energy, new and renewable, is essential in creating sustainable economy. Therefore, their music and their dance will deliver us to our next session. Ladies and gentlemen, please welcome Tari Kokosago. ladies and gentlemen, that was Coco Sago. And if you've noticed in their dance today, you might realize the message from Coco Sago in their performance is on sustainability. And it perfectly brings us to our last session for today's Gala seminar. We will touch upon the topic, green economy and finance. Ladies and gentlemen, please allow me to introduce our moderator, Mr. Marcos Neto. Mr. Neto is the Director of the Finance Sector Hub at UNDP as a specialist in sustainable development and is currently developing new private sector strategy and its offers on SDG finance. Ladies and gentlemen, please welcome on the stage our moderator, Mr. Marcos Neto.
Thank you. You know, I feel lonely up here. So I'm not going to sit down, right? Because it's kind of lonely. And I just found out today that I'm alone up here. But I do have a fantastic panel out there in the virtual world. Maybe you can put them up already there so we can all see our panel. We have had, on top of being lonely, I'm with the last session. So for you who are here, congratulations, you survived. But you survived a fantastic week. There has been an amazing week with a lot of discussion, and one of the major themes of this week has been around the green and the green economy and the transition and the need for just and affordable transition. And I think that's what we're going to be exploring today, culminating with this last session. We have a great panel. We have former Governor of Bank of England, Mark Carney, now a UN Special Envoy on Climate Action and Finance. He sent us a video. We have Bill Winters, CEO of Standard & Charter, Pak Darmawan, President of the PLN, Indonesian state-owned electric company, and Vivek Patek, the IFC Global Head of Director of Climate Business. Before pulling up the video from Mark, let me have a chance to try to frame this discussion today. We do have the challenging, as I said, to be in the last panel, but I do want us to think big, to look at moonshots. We've heard enough on the troubles that we are. We know the troubles. We know we have a debt situation coming on. We know we have geopolitical issues. We know we have a climate crisis, inflation, food insecurity. But it was also quite telling in the meetings yesterday that the central bank governors and the finance ministers also said that we can't take the eye out of the ball vis-a-vis the long-term needs and the long-term transition. We have to address climate change. And I would say, and that won't surprise anybody coming from the United Nations, we have to address the Sustainable Development Goals, Agenda 2030, to which the climate change is part of, right? And I think it's important, if we want a just, and then the emphasis on a just and affordable transition, the other elements of the Sustainable Development Goals must be on the table too. We need collective action. We need to ensure that we preserve our common home, the only one we have. Maybe Mr. Musk is going to take us to Mars one day, but I'm still betting on this planet first, and only at the moment. Last year, the G20 took a series of big steps on regarding of addressing climate and SDGs in all aspects. Leaders endorsed a sustainable finance roadmap, along with the G20 framework for voluntary support to the integrated national financial frameworks, the G20 high-level principles of sustainability, related financial instruments, and the G20 common vision on SDG alignment. This year in February, the G20 finance ministers and central bank governors communicate. The G20 reiterated the commitment to tackle global challenges such as climate change and environmental protection. And yesterday, in the difficult times we are in, the G20, under the Indonesian presidency, reinforced its commitments to support orderly, just, and affordable transition to achieve the Sustainable Development Goals and the Paris Agreement. This year, we see sustainable finance emerging as a priority issue across several working groups in the G20, both in the finance and the Sherpa tracks. The sustainable infrastructure at the Infrastructure Working Group, macroeconomic implications of climate change at the FWG, blended financing in the Development Working Group, climate finance in the Climate Working Group, and energy transition in the Energy Transition Working Group, to name a few. Now, I'm also the head of the Secretariat of the Sustainable Finance Working Group. And in our working group, we have particularly been working in looking at developing a framework for transition finance, provide key policy recommendations to scale up sustainable finance, focus on accessibility and affordability, and reflect on the key policy levers to increase bankability of sustainable projects and to accelerate the transition finance. And outside the G20, there is a plethora of other important work at a global level to put in place, if you want, the architecture of this transition. Now, how does this translate down to country level is essential. We at the United Nations Development Program have offices in 170 countries. So for us, it's very important to figure out how does this land in those countries? How does it become a reality, right, in daily work? So in line with the G20 framework for the operationalization of integrated national financial frameworks, today, more than 86 countries are using this innovative approach called the INFFs as a driving force to establish a more sustainable financing architecture at the country level to channel finance where it needed most. There are taking forward more than 250 reforms designed to mobilize and align public and private finance for sustainable development, and strengthening systems and platforms for better governance, collaboration, monitoring, and accountability of finance. We are doing this in partnership with the IMF, OECD, the European Union, and many other players around the world. During the next 12 months, 40 of those countries will develop the essence of an integrated national financial framework, which is the financing strategies, defining as countries, you know, what do they need finance for? How much does it cost? How do they want to split the cost between public finance and private finance? And then what are the reforms necessary to make the reality? We are hoping that this can help the G20 realize its strong commitment and unlock and align private capital to meet the more than $1 trillion needed just for climate transition. With this momentum, I want to turn it over for us to listen to the video of Mark Carney. Since the COP at Glasgow, Mark has been co-chairing the Glasgow Financial Alliance for Net Zero, representing 450 major financial institutions from across 45 countries, controlling assets of over $130 trillion, of which Bill, also from Standard & Charter, which is virtually with us, is an active participant as a principal. So if we can cue in the video for Mark Carney, it would be great. Thank you. Well, I'm very glad to see that I do have my panelists online. At least they're online. Can we have the video from Mark Carney?
I would like to thank the Indonesian G20 for inviting me to say a few words at the start of this important session on the role of the financial system in the net zero transition. G20 finance ministers and central bank governors are meeting at a very challenging time. They face surging inflation, ruptures in global energy and food markets, and stagnating growth. And these tough challenges are compounded by the deepening climate crisis, whose cost, absent decisive action, will dwarf current hardships. Now's the time for the G20 to prove its worth through bold collective action that turns crisis into opportunity. Action that accelerates the transition from our current energy system, a system that has proven once again to be unreliable, unaffordable, inaccessible, and unsustainable. Action that catalyzes the enormous private investment that can accelerate growth and create high-paying jobs across the G20. Action that supports just transitions in emerging and developing economies that have done the least to cause the climate crisis, but who will bear its greatest brunt. These actions can build on the foundation of a private financial system that's being reshaped for the net zero transition. COP26 agreed major reforms to bring climate change into the heart of financial decisions. And all members of the Glasgow Financial Alliance for Net Zero, or GFANZ, have made commitments under the UN's Race to Zero to, first, use science-based guidelines to reach net zero emissions across all scopes by 2050. Second, set 2030 interim targets that represent a fair share of the 50% decarbonization required by the end of this decade. And thirdly, set and publish net zero transition strategies and report annually on progress against these targets. And now GFANZ is developing the tools for financial institutions to follow through on these commitments and align their balance sheets with the transition, including its new net zero transition plan framework and open source climate data platform, a platform supported by the OECD and the IMF. The Net Zero Transition Plan framework was published last month. It's currently out for consultation. We intend to finalize it by the end of the year in time for COP27. This framework will support real economy decarbonization rather than paper or portfolio decarbonization. And it doesn't just finance climate solutions that are already green, although those are obviously critical, but also goes to firms in hard-to-abate sectors like steel, aviation, cement, with robust transition plans and the managed phase-out of high-emitting assets. The framework covers all the necessary elements of a credible transition plan across governance, objective, and carbon and target setting, business-wide implementation strategies, external engagement strategies, and robust target setting and metrics to monitor progress. It is supported by technical tools, including guidance on the use of sectoral transition plans, the managed phase-out of high-emitting and stranded assets, and how to assess portfolio alignment. We welcome the G20's support in ensuring the broad adoption and implementation of this framework, because it will help deliver the enormous financing needed for companies and countries that have plans to reduce emissions. Such transition financing will be particularly critical for emerging and developing economies. Delivering orderly and just transitions of energy systems away from coal and towards renewables will require a seven-fold increase in investment, an additional $1 trillion per year by the end of this decade across EMDEs. The private sector can provide the majority of this investment, multiplying the impact of public funds and providing the G20, or provided that the G20 has the courage to act. Unlocking private capital at scale and in time requires unprecedented public-private collaboration through ambitious G20 country platforms with the following features. First, country ownership and ambition. Each country seeking finance should lay out the significant emissions reductions that it intends to deliver, with clear timetables and projects. These are essential first steps to engaging development partners and private investors. Country platforms must have strong governance and transparency frameworks for identifying, developing, and labeling net zero line projects ranging from clean energy to the managed phase out of coal and investments in just transitions for workers and communities. Secondly, country platforms should have financing roadmaps that identify the costs of transition, financing sources, and their most effective use. Scarce public and philanthropic capital must be deployed where they're needed the most, and not in ways that crowd out private investment. For suitably ambitious country platforms, MDBs such as the World Bank should label the associated financings as being aligned with the net zero transition. Thirdly, EMDs and their development partners should lead upstream de-risking, including strengthening enabling environments with necessary policy reforms and through project preparation and pipelines. The world's total carbon budget to hold temperature increases to 1.5 degrees is finite and shrinking fast. The top priority is to get absolute emissions down rapidly. But at the same time, we need to do everything possible to avoid emissions and reduce the existing carbon in our atmosphere. Unfortunately, until now, it has not been possible to do that in a systematic manner because carbon credit markets have been fragmented and opaque. That's undermined credibility, hindered participation, and prevented the scaling of much-needed finance. And this is why the work of the Integrity Council for the Voluntary Carbon Market is so vital. By providing a global threshold standard for credible, transparent, high-integrity carbon credits, the Council's new core carbon principles will support the net zero transitions of companies, the reductions of global emissions, while providing much-needed financing to projects in emerging and developing economies and to indigenous peoples. GFANZ members are ready to support these efforts, including by working with local financial institutions to build the capacity to originate, structure, and deliver bankable net zero-aligned projects. And fourth, the official sector needs a fresh approach to downstream de-risking. If we're to finance on the scale required, MDBs, donors, and philanthropic capital must pool, blend, and deploy resources more flexibly and take on risk more effectively so that public money catalyzes large multiples of private capital. The G20 needs to maximize the impact of concessional finance by using it to underwrite the risks the private sector won't otherwise take on, including through more effective use of guarantees and first loss structures. All this underscores that fundamental changes are needed in the international financial architecture to support the G20's goals. The IMF is creating a path-breaking resilience and sustainability trust. MDBs have begun to innovate. But ultimately, even these efforts will run up against mandates, capital allocation rules, cumbersome processes, and constrained risk appetites unless the G20 leads more fundamental reforms. To conclude, by supporting the GFANZ transition framework, the G20 can accelerate the alignment of private capital with the financing of net zero investment. And by turning country platforms from concepts to realities, the G20 can turn looming disaster into launch pads for strong, sustainable, and balanced growth across its membership. I salute the G20 presidency of Indonesia for leading these efforts, and I wish you excellent meetings. Thank you.
Thank you very much, Mark. And I think a lot of what Mark is talking links very well with the work of the Sustainable Finance Working Group this year. Now, the connection between GFAN's framework and the transition finance framework that we hope to have it endorsed by November, I think it's incredibly opportune to unlock this capital. But let me talk to Bill here. Bill, thanks for being with us here. Just yesterday in the G20's chair summary, there was a call for further efforts, including from the private sector, to address the G20 sustainable finance roadmap and accelerate transitions towards net zero. Let me ask you a question to start with. How do we effectively attract private sustainable finance investments towards net zero in a way that is aligned with the G20 sustainable finance roadmap? And is there room for improvement on the current arrangements of global commitments towards low GHG emissions economies? Over to you, Bill.
Marco, thanks very much. Thanks for having me. And thanks for your comments. And as usual, Mark summarized a vast array and really a very complex area that involves initiatives in the private sector as well as in the public sector, and then, of course, the collaboration between the two. It's pretty clear to all of us, I think, that have been working on this for a while, that all of this needs to come together into a cohesive whole. And Mark, you asked the question, can we do better? The answer is most certainly yes, which is not to say that we haven't done a lot. We simply haven't done enough, and we haven't done enough by a long shot. So maybe if I could just take a little bit of a step back, I think there's a framework for private sector involvement in the entire sustainability agenda. And of course, it starts with the fact that the stakeholders for private companies feel a very compelling need to ask their private companies over whom they have stakes to take concrete steps in their own direction, but without being very specific. So I can tell you from the perspective of a Standard Chartered Bank, our owners, our shareholders, expect us to take action on climate change, but they're not being very specific about how to do that. We know that our clients and our customers expect us to take action. They're also not being very specific. And maybe most importantly, in terms of what we feel day to day, it's our employees expect us to take action. But they're not very specific either. So that leaves the managers of private sector companies with the task of identifying what can we do that will satisfy our various stakeholders, make our contribution to this overwhelming commitment that we've all made, and at the same time to mesh up and sync with the actions taken by others. And I think that there's a number of fronts on which we must pursue this. First and foremost is just getting the data right. As mundane as that sounds, we need to know where we're starting. Every private company, every investor, every shareholder needs to know, what's my starting position? What do I have in terms of emissions today? What am I taking responsibility for? Second is that's all about measurement, standards, and then disclosure. So taking that data and making it available to the various stakeholders. A lot of the work that was initiated actually by Mark when he was head of the Financial Stability Board around the TCFD was around measuring and making public those disclosures. And I'm very happy to see that both in the private sector and the public sector, standards are being established very clearly that make data aggregation, data accumulation, and then data dissemination a core and consistent process. The second is to map those pathways. So I know where I'm starting. I know where I need to get, which is net zero by 2050, with about half of that coming now in the next 8 years. What's my pathway? What's reasonable for the industry in which I operate, and what can I do about those difficult or impossible to abate emissions along that pathway? And that clearly is that there's some outstanding work being done by the Science Based Target Initiative and others to clarify what those relevant pathways are. Third is then holding us accountable to deliver against our starting point and those pathways. We know that holding private companies accountable means also holding them accountable for finding the financing. We know that in emerging markets in particular, where Standard Chartered has the bulk of its operations, there's close to $100 trillion of financing gap. So financing that's going to be required for emerging markets, countries and companies to affect their own transitions, that's not immediately available. It may become available, but it's not, we don't see it today. And we know that some of that will come from the banking sector. Standard Chartered is very, very active in sustainable finance off of our own balance sheet. We know that a multiple of that will need to come from the capital markets, so from institutional investors, asset managers, insurance companies, sovereign wealth funds, who have substantial resources set aside for sustainable finance, for transition finance, but who don't necessarily have the skills and the capabilities, or for that matter, the risk appetite in many cases, to make the connection between what they have, which is money and will, and what's needed, which is delivery into these various emerging markets, economies, countries, and others around the world. And this is where I think a lot of what Mark hit on in his comments, and you mentioned as well, Marco, around the need for public-private sector cooperation. When I look at the multilateral development banks, the export credit agencies, the national development banks, I see more words than action. So we see good underlying intentions, but the amount of money is far short of what's necessary to affect the transition. And maybe as important as the quantum of money coming from the public sector, which is a critical catalyzing tool, is that catalytic, that leveraging effect. So I would argue that we need probably 20 times the amount of money coming from the MDBs as is available today, which of course means incremental funding from their shareholders. But that money itself needs to be leveraged probably 10 to 15 times more than it is today. So what do I mean by that? That $1 of MDB sustainable financing today generates about $1 additional of private sector funding. That's simply not good enough. Right? What we need is to get that $1 of MDB financing to catalyze something like $10 to $15 of incremental funding. So if we increase the amount of MDB available financing by, let's just say 10 times, and we increase the leverage factor from 1 to 10, that's 100 times the money that we have available today simply through that public-private partnership. And when you add up what's necessary, together with what banks can do themselves, what capital markets can do themselves, then what we can get through blended finance with the MDBs catalyzing private sector capital, then you start to get close to the $94 trillion that's necessary to affect this net zero transition. Without all of those cylinders firing, not just at the same time, but with the right rhythm, it'll be very difficult to hit our objectives. So happy to talk some more about how we can do that, but I know that we
Thank you, Bill. I'm going to come back to you in a minute on this need to use the MDB resources in a different way and ask you about what you think are the best instruments. But I'll come back to you in a minute. Let me go to Pak Damawan. You run an electricity company, you know, and we had a great launch of Indonesian's country platform, as Mark mentioned, and ETM, the transition mechanism, right? So in the context of energy transition, which is what that can be done to ensure inclusivity and transition towards green economy, especially in developing countries, which in the current scenario have limited policy space and have some structured challenges. So the floor is yours.
Thank you, distinguished guests, distinguished speakers, ladies and gentlemen, and the Mr. Moderator here, Pak Marcus Neto. You know, it's a paradox, Pak. You know, like 13 years ago, I was part of the environmental team at Duke University working on the Cap and Trade, American Power Act. And today I'm the CEO of PLN, national electric company that own and operate among the largest coal-fired power plants in the entire world. So I'm becoming like, feeling like a Darth Vader joining the other force. But, when we're talking about inclusivity, we need to understand, you know, what does it take to mitigate the climate change first. Today, for instance, is in the PLN as the national electric company. The emission of PLN today is roughly 280 million metric tons annually. And then by 2060, it's going to increase to roughly 1 billion metric tons annually if it is business as usual. But of course, we're not going to let that thing happen. The Earth is warming. We need to reduce CO2 emission, and PLN is fully committed exactly to do so. And we have done so many things. We have been removing like 2 gigawatt of coal in the planning stage, and it's been released in the National Electricity Planning, the latest one. We've been replacing 1.1 gigawatt of coal with the renewable energy in addition on top of it. And then on the new National Electricity Planning from today until 2030, 51.6% of additional capacity is coming from renewable energy. We're tapping into, you know, geothermal, wind, solar, you know, and also hydro, etc., etc. Every single possibility of renewable energy. And what is the main challenge here? When we're talking about renewable energy, we're talking about clean energy. Today, by today standard is expensive. When we're talking about, cheap energy is dirty. There is a challenge, there is a dilemma. And can we sustain this kind of dilemma? Of course not in the long run. Yes, we can add more renewable energy, but we're going to have to impose upon the feed-in tariff. That's going to be additional burden to the state budget, which is going to make it not very sustainable in the long run. When we put a lot of burden into the state budget, we're talking about the reduction of a stunting program. We're talking about the reduction of education for the poor. We're talking about, you know, the poverty eradication program that has to be reduced also. So that is not going to be sustainable. The only way to sustain, if we can solve the dilemma, but I'm going to share with you. 2015, when PLN actually auctioned the solar energy, it was 25 cents. 2017, it was already reduced to only 10 cents. And today when we auction it, it's only like roughly 4 cents or 4.5 cents. So you know what that means. That means that the price of renewable energy is going down year by year, month by month, week by week, day by day. Humankind innovates. And even the battery energy storage systems, 6-7 years ago, is roughly 46 cents per kilowatt hour storage cost. Today, so 11 cents is not cheap. Yes, it's not cheap. But this is a reduction of 80% compared to the price of 7 years ago. If we maintain the trend in the next 6 or 7 years, the price is going to go down furthermore. That means, we still believe that renewable energy can compete with fossil fuel in terms of technical, in terms of system, in terms of commercial, in terms of economics, which means that the dilemma that today we are facing when we're talking about like cheap energy is dirty, when we're talking about clean energy is expensive, humankind will be able to resolve that one. In the future, when we're talking about clean energy is cheap, the only way to move forward is using the cheap energy, which is going to be also clean. Then we're going to be able to solve the dilemma. Then in that regard, how we're going to be able to combat climate change, which is going to be sustainable, just and affordable, is going to happen. It's going to take place. How? Through humankind intervention of innovation. And that's why this is very important that this is a global problem. It's a global effort that the emission of 1 ton of CO2 in Indonesia is going to be exactly the same amount of emission of CO2 in Ankara, in Washington, D.C., in Paris, and all over the world. So it has to be global effort. And how we talking about the inclusivity? Today, how much capital expenditure that we need exactly to combat climate change? From today until 2030, we already compute we need additional of roughly $35 billion additional funding. From today until 2060, and today the size of the electricity sector in Indonesia is roughly 265 terawatt hour. Increasing demand is roughly 5% annually. By 2060, it's going to be 1,800 terawatt hour. How much capacity that we need to add into the system is roughly 400 gigawatt additional capacity. How much funding do we need? Roughly $500 billion funding. And we're talking about GDP, consumption plus investment, government spending plus export minus import. Can you imagine $500 billion additional capex that we need to combat climate change? Mostly is coming from import. That going to be, affect how we're going to treat our economy. The transition of energy, the additional of renewable energy, it has also to accelerate growth, to create more jobs, to eradicate poverty. And the only way, if we are able to do that, if we build our national capacities, look at China in 2001. The energy mix coming from coal was only 46%. And look at China in 2009. The energy mix coming from coal increasing to roughly 80%. But in the same period, China developing so much national capacity. In that regard, China dominates the market of renewable energy. Solar, wind, everything, battery energy storage system, mostly the domination product is coming from China. So China treats climate change not only as climate change problem, but China treats this as a way to expedite growth, to build national capacities, and in the same time dominating the renewable energy products. In that regard, they can align the transition of energy, the addition of renewable energy, in the same time accelerating growth, creating jobs, and eradicate poverty that in which they need the most during this time. So in that regard, it's like this. When we're talking about inclusivity, we're talking about the local wisdom. First, we understand the balance of the system in each area in Indonesia. And we also understand how we're going to tap into the source of renewable energy in the area. But again, when we develop the renewable energy, we need to build the national capacities. We need to understand the value chains from the upstream all the way to the downstream. We're talking about the technology, we're talking about the innovation, we're talking about how we're going to deploy our workforce in such a way there will be a shift of core competency. In PLN alone right now, I have 10,000 people working on the thermal technology, coal, natural gas, etc., etc. How we are going to be able to transform the old core competencies to the new core competency. It's a shift of paradigm. It's a shift of technical know-how. It's a shift of technical knowledge. So we need to do retraining. And how are we going to do this? We have announced the carbon neutral by 2060. Previously, before as a business as usual, the emission of carbon in 2060 is roughly 1 billion metric tons annually. But with this kind of program, we're going to reduce it to zero. And so much need to be done. First is the paradigm of shift. We need to have the way we have to approach this goal. We need to see this not only as a challenge, but we see this as an opportunity. Opportunity that PLN today, I have 55,000 employees. I manage roughly 64 gigawatt, 110 billion US dollars assets. Revenue is roughly 27 billion US dollars annually, etc. So we need to manage. This is a big shift. We need to realign ourselves not only to the past, but mostly important is we need to realign ourselves to the future. So it's a big challenge. It's a big challenge. But I'm still seeing this as an opportunity that today PLN, our main job is to provide electricity. Yes, we do. But in the future, our main job is to take care of the environment, while electricity is only our byproduct. Time is yours.
Thank you very much. I think it's a fascinating example. I think, what you describe it in this electricity transition, issues of skilling your own employees is a microcosm of the entire transition that needs to happen in the economy. So you brought to us in one piece what I think needs to go around everywhere. Vivek, thank you for being here. I'm assuming you're in Washington, which means it's very late there. So, kudos to you for joining us here. I'm going to shift gears to one important conversation that we heard in the room yesterday with central bank governors and finance ministers, and it is a priority on the Sustainable Finance Working Group, which has to do with SMEs. You, the IFC, a lot of what you're doing is working with the private sector and supporting the private sector around the world. There is a risk that this transition can create more bottlenecks for SME to access capital, to with new regulations on disclosures and all of those aspects, making life more difficult. So, what can be done to promote SME participation in the transition? What can be done to promote market access for SMEs, including new financial instruments? And how can we do that in an orderly way, right? So they are brought into this transition as the essential players that they are. 90% of all jobs are created in the developing world by SMEs. So over to you on that aspect.
Well, thank you so much, Marco, and it's good to be on this panel with Bill and Pak Dharmawan and Mark Carney. I actually happen to be in London, so it's really early for me, but that's fine. I'm just going to touch upon a few things that were said earlier and then come to SMEs because it's all related. I think what Pak Dharmawan said is relevant for his staff, for his employees, for people in his sector. But it's actually equally important for the entire economy, because if you move towards an economy which is low carbon, if you move towards an economy which is different, very different from today, and I suspect the world in 2060 is going to be very different from the world in 2022, you may solve the carbon problem, as I keep saying, but we're going to have a new problem, which is of unemployment, of people which are going to be without jobs. And we saw this happen when the technology shift took place and still taking place, where jobs were created in new countries, where you had BPOs and offshoring, and jobs actually were lost in some countries. And therefore, to provide the necessary skills to employees and to SMEs is going to be critical. Now, what's happening today, unfortunately, is a lot of the capital that's being talked about and the technologies are being made available to the larger firms. And I'm not saying that I don't have a problem that I'm confident that these larger firms will make it, but I think the larger firms have access to capital, they have access to technologies, and there's a cost issue there, and we should address that. So I think they will get there. But what's going to happen is, as global value chains get green, the SMEs, if they're not able to get green, and they're going to be left out of it then. And therefore, it's important that we look at how to get them to where we need them eventually, which is towards a decarbonized pathway. And part of that is something that we are trying. And just by way of information, we just closed our fiscal year and we did more than 1/3, 35% of everything that we did last year was in climate, which I think is quite incredible given that, or creditable, I wouldn't say incredible, but creditable given that we've got the war in Ukraine going on, we've got a food security crisis looming, and we are still recovering from COVID. So our focus on climate continues, and we should see how we can leverage up. I could completely agree with what you said, Bill. But I think in that context, I think what can we do with SMEs? So I would like to put out 2 or 3 things there. One is IFC has embarked on a Paris alignment process, which means starting 2025, all our portfolio will be Paris aligned. This includes the SMEs that we will be reaching through our financial. And that, I think, is going to be a significant shift in the way some of these SMEs are going to be doing business. And to get there, it's a Garangutan task. We are setting up a huge platform which is going to provide advisory as well as financial services. So the SMEs need advice. They need a pathway. They need someone to guide them. They do not have it available to them right now. They don't have the means to access that technology. Neither do they have the financial means. Second is, I think we need to remember that SMEs typically live on what I would call a hand-to-mouth. You know, a 3 or a 5 day delay in receivables means their factories or their businesses could potentially shut down. So they need a pot of capital, which is long-term or medium-term patient capital, which will help them get there. The positive, I think, when we've talked to sort of scope 3 suppliers, to some of the large firms and their suppliers as well, is I think we have to also impress upon them that a lot of what is being done is actually going to help reduce costs. If you look at energy efficiency, if you look at alternative sources of power today, and you know, Dharmawan just mentioned how solar prices have come down, I think all this will eventually lead to a reduction in costs over time. The first few years, there may be costs, but over time, these costs will come down and SMEs will be able to pay for this on their own. I'll just give an example, which I love, is on green buildings. A green building today takes a new green build. The payback period is down to about 3.5 years. So my sort of challenge to all our commercial banking friends is, why can't we partner and green your entire portfolios? And I know Standard Chartered has embarked on that with us. But Bill, I really hope we can do it across the world with you for all your clients. And that, I think, will be able to demonstrate that climate is just not a cost issue, but climate is also how you're going to make more money in the medium to long run. So I think it's a combination of all these factors that I think we will need to make it happen. Last but not least, I think let's also understand that there's a huge pool of capital available for climate today, but that pool of capital is not going to come into SMEs. You know, the pension funds, the pensioners, I don't think have the risk appetite to invest in an SME in Indonesia or India or Papua New Guinea or Chile. They don't have that. They're not allowed. The regulators will not allow that to happen. So at the same time, I think it's absolutely critical that we start to build domestic markets. How do we green the domestic financial sector from A to Z? And I think that's where, honestly, if I have one sort of wish out of this, is there's a focus on that. How do we channel domestic pension money into climate? How do we channel domestic savings into climate? And if you're not able to do that, I hate to say it, but we will not get to the 1.5 degrees, because we have to remember 2-3 things. Having lived through 2 currency crises in my life, one in Thailand and the second one in the Middle East, if all of this dollar foreign currency that we're talking about, which exists, if it starts coming into countries may solve the climate crisis, but they're going to have a currency crisis. And how do you manage so much foreign currency? And there's currency risk involved. Every time there's an ITP denominated in dollars or cents nowadays, somebody's going to take the currency risk, and it's not the lenders. So, maybe we MDBs can be asked to de-risk part of it, but we just don't have the capital to do it all. I would rather use de-risking capital today to de-risk domestic savings, domestic pension money, and try and see how we can over time get this to flow into the SME space and help these SMEs over time to transform and not only become more green, but in the bargain, they will also become more profitable and viable. Thank you.
Thank you, Vivek. Bill, let me go back to you with picking up on the point you mentioned on having to leverage public capital exponentially larger than we do now. What do you what is emerging in that front from your point of view as the most interesting instruments that can give that best leveraging return, if you want? And by the way, congratulations on signing up with Liverpool again.
Thank you very much for that. That was the easy part. Fixing the climate is getting a little bit harder than backing a winner, as we say. But it's an excellent question. What are the tools that work? And when I look at the components of the overall financing structure that are the real blockers in terms of unleashing the very, very large volume of private sector capital that wants to be involved but is having a hard time getting involved, it's probably two things. First is the underlying political risk. So the risk, these are typically very long-term projects, of whether they're corporate transition financing projects or renewable power projects, as PLN, for example, is extremely familiar with. These are long-term investments, and the political landscape shifts over periods of time. Whether that's the underlying power offtake agreements, we call it political risk or call it commercial risk, but it sometimes has a political overtone. Or outright political risk. MDBs have been excellent through decades at dealing with that very specific risk segment. It's not small in many cases, but that is the first risk that prevents many, call it generalist institutional investors, from investing in particular in emerging markets sustainable projects. And second is project-related risk. So it's especially during the construction and development phase. When we look at bank and insurance regulation in most parts of the world, that flows through to pension regulation in many regards. There's a really big disincentive to take either long-term risk or project/construction risk. And I know for a bank, it's almost impossible to take project-type risk when you look at the capital that's required to be set aside for us during the construction period. Again, these are areas where the public sector should it deem that that's the best way to effect a transfer from effectively the shareholders of the MDB to the companies and countries that are receiving, would be to take some of that project level risk, technical risk, off the hands of the private sector. I think those are two tools in place, and there are plenty of insurance mechanisms in place. ADB has been excellent for quite a while at targeting capital at those types of risks. The World Bank and in a different way, the IFC are similarly very capable. But what we've seen a little bit too often, and maybe this is not so much ADB but others, is that the sorts of risks that the MDBs are comfortable taking on is the same sort of risk that the banking sector or the capital markets are prepared to take on. And that's not so helpful. So when they're taking on the same amount of risk, that's when the leverage factor drops to 1. $1 of MDB financing unleashes $1 of private sector capital. Not worthless or meaningless, but it's just not enough. And to the extent that we can get the MDBs comfortable targeting their capital at the risk that really unlocks private sector capital, we can get that multiplying effect.
Thank you. Do you want to say anything about the SME from your point of view? You are a bank with a huge footprint in Africa, for example.
Some standard pathways that are sort of endorsed by the Science Based Targets Initiative or the International Energy Agency for small businesses. And then to have a few, and typically there's always the 80-20 rule. You can probably capture 80 or so % of the of the opportunity with 20% of the resource. And to have a standardized set of products that we can deliver through the various channels that we've got. It could be through banking channels, it could be through the telephone companies, it could be through other local distribution channels to get a consistent sort of chipping away against these pathways that have been set out. I think that's really the only way to tackle the SME problem.
Thank you, Bill. I'm getting somebody texting me here, some technical challenges that are going on. Do I have anybody else out there or not?
We can hear you, Marco.
Good. I can hear you, but I can't see you anymore. It's Vivek, are you there as well? Oh, yeah.
Yeah,
now
I'm
I can
here.
see everybody.
I'm here. Yeah, I'm here.
Fantastic. Thank you. Thank you for sorting it out. Pak Dawan, I was asking you, you mentioned $35 billion, $500 million is a lot of money, right? And Bill was talking about instruments and what needs to happen for that leverage between public and private capital to take place. From your point of view, what are the most exciting instruments that you are seeing out there that can help you raise the capital to move that transition that you were talking on?
Well, thank you for the question, Marcos. The first thing is we need to design environment that is conducive for investment. And what does that mean, actually? What does that mean, actually? When we need to sign a contract with a third-party provider of this renewable energy. Sometimes we do the EPC, engineering procurement contract on our own. But when we sign a contract with a third party, we need to come up with a contract that is based on the spirit of fairness. What does fairness mean? You know, if somebody invests in our ecosystem, we need to ensure that the investment can be recouped back. If there is any risk, you know, right here, Bill Winters already said, like, you know, political risk, technical risk, financial risk, etc., demand risk, etc. The risk has to be very well calibrated. And then, of course, when we're talking about the spirit of fairness, the rate of return. If the rate of return is lower than the cost of fund, then nobody going to invest. It's better off for them to put their money under their mattress. And that is very important, to design environment conducive for investment. And then in this case, we also have what we call the energy transition mechanisms. This is a global problem, it's a global challenge, and it has to be a global effort. So PLN, I have to admit, we're not going to be able to face this challenge alone. The only way to move forward is through collaborations. Collaboration of what? First is policy. Collaboration of what? Strategy, technology, innovations, investment, every single thing. Collaboration in terms of domestic, regional, international. We need everything. Otherwise, it's not going to work out. In these energy transition mechanisms, we are thinking how we're going to make rooms for additional renewable energy to enter our system. How are we going to do it? We're going to retire our coal-fired power plants earlier than scheduled. So in that regard, we need a low cost of fund. Without low cost of fund, there is no way the payback can be expedited. So when we have a low cost of fund, we have a framework of policy. We've been working with the Asian Development Bank. We've been working with the donor countries. We've been, the non-disclosure roadshow all over the world, in European countries, in Japan, in the US. How are we going to be able to marshal this, not only as a PLN effort, not only as an Indonesia effort, but as a global effort. And this is a very complex challenge. There are so many goals here, but one of the goals is going to canceling out the other goals. So it's multiple conflicting goals. We want it to be efficient. We want it to be fast. We want to reduce as much as CO2 as possible. So this is all the multiple conflicting goals. So it's very complex. But the only way to move forward is we can come up with a scheme in which investment green investment is going to pour in, and we're going to be able to ensure that it's commercially viable, but in the same time, coal-fired power plants is going to be retired early. As simple as this. Some of our coal supposed to be retired in 2044. With the scheme of low cost of fund, we do the financial modeling. The payback is not 20-something years, but the payback can be expedited only 11 or 12 years, meaning previously it's going to be retired in 2044. Now we can retire it, let's say, 10 years earlier. For 1 gigawatt of coal, the emission is roughly 6 million metric tons. So if it's 10 years, 6 multiplied by 10 is roughly 60 million metric tons of CO2 avoidance. And is it going to happen? We are trying very hard here as a platform or part of the G20, showing the world that we can combat climate change using a commercial tools, market tools, market-based, solution in such a way it works. But of course, we need some kind of a complexity that need to be solved. Multilateral financing, green financings, multiple countries, donor countries, the government of Indonesia, even the investors is asking from the regulatory framework from the Indonesian side. Is this going to increase the price of electricity? Yes, it's going to increase a bit. So we need some kind of a government regulation that going to tolerate some kind of increase by taking into account the CO2 reduction. Is it going to increase a little bit of our subsidy? Of course, it's going to increase, but it's only a little bit. The Ministry of Finance, by Bu Sri Mulyani, already supporting this program and incorporated this by the financial strategy to combat climate change. So in that regard, is it a big challenge? Yes, it does. But I think we are able to overcome this by not doing this alone, but doing this through collaboration, multilateral. It's a global problem. It has to be a global effort. Thank you.
Thank you. And representing a global institution, we really look forward and we'll work with you to make it work here so it can go to other parts of the world, because the need to retire fossil fuel earlier, it's a need that happens in many, many countries. So count on all of us, I would say, to support on that. In fact, there was a lot of conversation about this leveraging and coming together of public and private, and I think, there's a lot of, I had a friend from the IFC many years ago who told me that you guys were the first impact investors in the world. From your point of view, what else do you, and what else needs to change in that IFC business model, to then bringing in people like Bill, capital, and investors at a much larger rate than it happens now? So over to you.
Yeah. So, well, thanks so much. And so I know there's been a lot of talk recently about the fact that MDBs need to be doing a lot more. And I think the term that's being used is first loss, and I partially agree, but I don't fully agree. So I think Bill referred to this whole thing of de-risking, getting a pool of assets, the MDBs, and there are a few like-minded banks that would come in, take construction risk, and when it's de-risked, then you parcel it out, you securitize it, and you try and get in commercial capital, particularly institutional capital. We actually did the first one many years ago, interesting enough, in Indonesia with a hydro company called Dharma Hydro, and it worked very well. We got in quite a few Japanese investors. We've tried to do it at scale, and I think some firms have succeeded, but what we're finding is that there is just not enough diversification. The environmental standards are so diverse that it's becoming hard. We are, as we speak, trying to develop a platform which will do exactly that, where we will get in a lot of early stage projects. Once they're de-risked, once they're operational, then you can hopefully try and attract commercial capital in them. And so that's one solution, really. The other one really is, and I think by way of background, I'd like to just state that even if all the MDBs was to only do first losses, which would effectively mean a lot of our other priorities may not be met, we will still not have capital for that. Just 1 minute, please. Yeah, so I think the second thing that we also need to focus on is how do we open markets, especially the larger markets. And I think India is an example that comes to mind, where the MDBs, largely the World Bank, IFC, we did the first 2 megawatts of commercial in India. We took a fair amount of risk. The World Bank and the ADB did a lot of reform. And today, India is, I think, the 4th or the 5th largest solar market in the world, attracting large pension funds. It's attracting a lot of global capital. And I think that's really what we need to try and do for the bigger markets. We've done something very similar in the Philippines when it comes to green bonds, in Chile, Brazil for renewables, in Colombia for capital markets. We really need to step up our ability to do that at scale, especially in the larger markets. That's how we can then go to Bill and say, okay, this is what we've done in India, and now your commercial capital will come and flow in. But what does that take from us to do that? It takes a lot of time. It takes us 3 to 4 years, if not 5 years, to develop these projects, to sit with governments, to sit with people like Pa Dharmawan. What will it take to open up the Indonesia energy sector? And that's a process which I think has to start yesterday. It started in a number of cases, but we actually set up a whole group called Upstream, and their daily job is to really see what can we be doing 3, 4, 5 years down the road there. So again, what we need is, and this is an important point I want to make here, capital for climate is not a challenge today. I think there's adequate capital. We can talk about de-risking it, but what we are seeing is when there is a good project, and I'll give an example which may not be the best for a climate change workshop, is we did the first IPP in Malaysia for a gas-fired power plant. We did not have problem raising finance for that. The commercial banks were willing to come in. It was a very well-structured IPP, so people were coming in. But what we're really lacking today is we're lacking projects. We're lacking bankable projects. So I think what we really need, and I'm hoping this is what we'll get at Sharm el-Sheikh. In Glasgow, we had the financial sector in full form and really making fantastic commitments and really challenging commitments, I would say. But what we really now need is to get the manufacturing companies, not just the global ones, but the regional ones and even the country level ones, to come and say, what are they doing about climate change? Because capital is there, I can almost guarantee you that. We can de-risk it, we can make things happen. But if there are no projects, if firms are not going to move, whether it's the SMEs, what we talked about earlier, but honestly, that is where I would say we need a call for action, is for the corporate sector, for the manufacturing companies, to really come and say, not only what are they doing at decarbonizing their operations, but their entire supply chains. And my experience has shown, I don't think we're there yet. So I would say these are the combination of things that we need to really be able to attract capital at scale. And I'll again come back and say, we cannot forget domestic capital, because global capital will always want to be de-risked. There will be currency risk always. And global capital needs large markets. So I think we really need to spend a lot more time on focusing on the domestic companies and the domestic financial sector. Thank you.
Thank you very much. I think you bring it on a very important point on the bankable projects. Not only they need to exist, they need to be a scale, but they need to be designed in a way that they deliver, right? That, green economy and the sustainable development goals. We at UNDP went on to create a methodology a few years back to analyze NDCs, the National Determined Contributions to the Paris Agreement, the SDGs, plans of the governments, and trying to convert those into investment opportunity areas. We've done that in about 40 countries. We actually launched a global platform. You can see those investment opportunity areas with their return on investment, with their business cases, but beside it, the development case. So you invested on that, here's what you get it from a development return as well as a financial return. So it's an offer that we have it as a public good for anyone to look at it in that aspect. We have about 10 minutes or less left. I wonder if there is any question to our panelists here otherwise I would just give them a few minutes for last thoughts. Huh? Time is up, sorry. So let's give us a round of applause to our panelists. I do hope to one day be in a big stage with you rather than alone here, because it's kind of a lonely scenario here. And on top of tech challenge, and you guys disappear for a few seconds. But I think we've got the message, and you have been great speakers. And I want to thank the Indonesian presidents for putting this gala for this whole week. I think we are all leaving Bali, after this week with the eyes wide open on the challenges that we all face, but with a sense of optimism that, we have all the tools, and as Vivek said, we have all the money to make this happen, right? We just got to make it happen somehow. So thank you very much. Thank you, everybody.
Thank you very much, Mr. Neto. Mr. Neto, if you would take a seat, we'll take a picture with all our panelists. All our panelists, if you would stay online, let's take a picture with our moderator. I'll count down from 3, 2, 1. Thank you very much. Ladies and gentlemen, let's give another round of applause to our moderator, Mr. Marcos Neto, and all our panelists today. And that concludes all the Gala seminar. Thank you very much to all moderators and all panelists who have taken part in our Gala seminar, which has reached the end seminar. We have come to the end of the G20 Gala Seminar Side Event Series today. Let me give you some information about our next agenda. We will now be serving lunch at the Jimbaran restaurant. The Jimbaran restaurant is located at BNDCC 1. Just a little way to show you, as you exit this room, you may turn right and exit through the glass door. So go straight to the glass door, exit through there, where you will find a beautiful glass building. Well, that's not it. That is Taman Jepun. And that is if you want to buy Indonesian wastra or Indonesian textile, please do that there. If you want to go straight to the Jimbaran restaurant, just go through the glass door, pass the glass building, and it will be on your left. And you go inside another building right there. The restaurant will be on your left. So hopefully you could easily find the Jimbaran restaurant. But we do encourage you to stop by Taman Jepun to check out the Indonesian textiles there. On behalf of the committee, I'd like to thank everyone here. Thank you very much for your active participation. Let's give a round of applause to you all throughout the week and throughout our Gala seminars until today. My name is Timothy Marbun. I thank you once again, and I wish you a wonderful day. Don't forget to enjoy Bali while you're here. Thank you very much. We'll see you again. Goodbye.